I welcome you all to this auditorium. It's been quite a while. Happy to see you all in person. No social distancing, no masks. You can get closer together if you want to. If you're with us digitally, welcome also to you. We also have some of our presenters today with us in a digital format. This is all the challenges of digitalization of the economy, including holding hybrid meetings, but we will try to make this work. We are learning from IFA, we'll do the best. We have with us here Gail to my left, and then we also have Damon from TUAC, who had actually been in the room for the last 10 minutes, but didn't know he was meant to come on stage. So we are now all here assembled. We also have Michael Plowgen with us, and I hope we also have Alan with us, sadly digitally, but I think he is with us. There he is. Excellent. Now, I am going to be very brief in the beginning, so I can talk a little more towards the end of the introduction. And I will start with the part that is the housekeeping items, for which I have exactly 2 minutes, and I'll try to do this. So housekeeping. There is a live translation available in English and French. In the room, there are headphones. Otherwise, if you're looking on Zoom, you can press a button and then it works. The meeting is being broadcast, recorded, and will be made available online. So be open, but at the same time recognize that everything you say can be used against you. No, but it is just to say that this is being recorded. You can also join the conversation on social media by using /pillar1 and at OECD #GlobalTaxDeal. Then if we go to the next housekeeping items, here is the agenda. Shouldn't surprise you. This is our agenda. We're part of the introduction where we are 10 minutes late, but we're catching up. We have the panel 1 on marketing and distribution, profit safe harbor. Then we'll have a quick break, and we may have to cut in the break if we run a little longer. Then we have panel 2 on elimination. And then panel 3 is other selected issues, and I'll be the moderator of that. And I can explain the logic, if it's not readily apparent to you, of that panel 3. I'm happy to explain it when we get there. And then we have brief closing remarks. I think that is my housekeeping items, unless Eric tells me otherwise. And after this, I think I hand it over to the co-chairs of the TFDE, and I think it is Gail who's going to kick us off. Over to you, Gail.
Thank you very much, Harim. Hello to everyone. Bonjour à tous. So it's a pleasure to be here in a hybrid meeting. So it's not an empty room. It's not behind the screen, but lots of colleagues are still online. First of all, I would like to thank all the contributors to this public consultation. I don't remember how many pages we received, but I'm sure that Arim will provide all those statistics at the end. But for sure, as usual, a lot of interest with regard to the public consultation launch, even if we kept you busy during the summertime while we were having a good rest. Well done for you. So just a few words about this public consultation document. It's the product of the TFDA, which has worked intensively for months to issue this consultation doc. So it's not an agreed document as such, but why should we consult people on a finalized document which is agreed? You would have raised the question. So, but in the meantime, it's not only a secretariat document, it's really the result of the intensive work that we had at the TFDE level. This consultation document already takes on board lots of the inputs received on the previous consultation process, including interaction with the business through the business advisory group on many aspects such as scopes, exclusion, sourcing, tax base, and so on. The focus today, because that were probably the two most important and new pieces that you had to look at in the course of this public consultation, will be on the so-called MDSH, Marketing and Distribution Safe Harbor, and on elimination on double taxations. So, as I said, your inputs are critical and will be, as usual, be discussed with delegates and taken into account, even if this is a policy issue. So in the end, the last word and the decision will come to governmental delegates, but in the course of this construction about the Pillar 1, it has been very important to take on board all the inputs received from the stakeholders. This is not the end, fortunately or unfortunately for some, because some aspects remain to be worked on and on which we currently work with a view to issue hopefully soon another consultation document with a major piece, tax certainty, which is so important for all of us. And also we are working on administration, and we also work on another piece which is less technical and more political, but which is also important and part of the agreement, which concerns the removal of unilateral measures once Pillar 1 will be implemented. We have a tough deadline, so you know it has been expanded up to maximum the end of the first semester 2023. This remains a very challenging deadline. If we want to have a signing ceremony by there, and I don't say if because I don't think it's an option, but so we will have to have that signing ceremony by then. It means that we must now work harder than we did, and we also have to start soon drafting the MLC provision. So it means finish the job, compromise, and fix the issues. So it's challenging, but it is as simple as that. Thank you. So now I hand over to my co-chair, Michael Plodjian, which looks perfectly fresh, even if he manages to be there and wake up at 6 o'clock in the morning, which I couldn't do.
Thanks, Gael. Hello, everyone, and apologies I can't be there in person. Thankfully, Ty is able to be there. I really just want to echo Gael's comments. We really appreciate the input from those who submitted comments, and really look forward to hearing from the panelists today. You know, I think, as Gael mentioned, while the progress report is not finalized, it would have been strange to consult on a finalized documentation. And really, our goal was to provide enough detail on key terms for stakeholders to engage in a meaningful way. And based on the comments, we accomplished that goal. As Gael mentioned, there are also several important building blocks that remain, including Amount A, which is an important part of this work. Work on that piece has been ongoing, and we intend to consult on that as well. And as Gael also mentioned, we'll be pivoting to the negotiation of the text of the MLC soon, so that we can meet the deadline for signature by the first half of 2023. And so with that, I will turn it back to Akam.
Thanks for turning it back to me. I think I will quickly turn it over to Alan, who is also with us, sadly not in person, but we have him here, so the floor is yours.
Thanks very much, Achim. I hope everyone can hear me okay. And thanks to OECD and also to the task force for this opportunity to say a few words on behalf of business at OECD. I'm sorry that I'm not able to be there in person, but I'm pleased that many of our business at OECD Tax Committee colleagues are physically there, and many others are on the virtual line. I'll be brief. I think this is an important day, a really important opportunity for us to engage on the progress report. And that, of course, is important not only to those currently in scope covered groups, but important to all of us, because it does mark this significant change, turning of the page, I think, in Pascal's words, on the international tax order as we know it, so entering into a brave new world. So really important that we have this opportunity to engage and to consult and to provide our input on that. The progress report itself is an important milestone in what has been a long series already this year of engagements on many of the individual building blocks, and we in the business at OECD Tax Committee have been delighted to have the opportunity to engage on each of those building blocks as they've been released, recognizing that much of that activity has been pretty frantic and pretty paced in order for us to be able to provide meaningful and hopefully constructive comments as we've gone along. And we recognize the extraordinarily hard work and excessive amounts of time that members of the task force have been putting into making those papers available to us and to responding to the comments that we've been able to provide. My special thanks, of course, to Janine and to Phil, who've led the Business Advisory Group, and to all members of the Business Advisory Group and the Tax Committee for the work that they've done in that frantic pace to keep us focused on the key elements of what is a really complex and difficult challenge. There's still lots to do to make this as workable as possible, and I'm sure that the panel sessions that we have that focus really on those areas that have been most important to us and where we've been able to provide some feedback in our latest feedback comments. So look forward to the actual discussion on some of those matters and hopefully the ability to make some progress. I think summarizing from our business perspective, what we really like to see focus on is simplicity as much as possible in the rules as they become finalized, but also clarity, so that everybody understands exactly what's expected of them, by when and in what form. And then finally, certainty. That word has already been used. Hopefully, the rules themselves will be so simple and so clear that there won't be a significant need for additional certainty mechanisms, but we all recognize that these are extraordinarily complex rules. They're completely new and break new ground in a way that where I think we'll all be looking to take advantage as much as possible of all opportunities to establish certainty. And I think that will require a different kind of engagement and cooperation between taxpayer and tax authority to make the rules work as we go forward. But with that, I wish everyone a very successful day of consultations and hopefully taking us further forward after today, so that we can continue to face the remainder of the challenges over the remaining weeks and months. Thank you.
Thank you, Alan, and then over to you quickly, Damon. The floor is yours.
Thank you, and good morning, good afternoon, I guess. I'm Damon Silvers. I am not quite the title that you see on your screen. I'm a senior advisor to the president of the AFL-CIO, the American Trade Union Center. I'm also a visiting professor at University College London. I'm here speaking on behalf of the Trade Union Advisory Committee to the OECD. I should mention perhaps that I serve President Biden on the transition team for the Treasury Department as well. I want to begin by, and those of you who are familiar with OECD processes may be surprised, I'm going to begin by agreeing with Alan about the core mission in front of us here, which is, as Alan put it, simplicity and clarity. I've worked in various forms for the labor movement at the OECD for more than 20 years. And this document is the most complicated and opaque document that I've seen in the entirety of my work. And that is unavoidable. It's unavoidable. It's not a criticism of the OECD team that has worked on this in the slightest. They have done an extraordinary job trying to embody the rather less than fully clear mandate that they've received from the governments entering into the inclusive framework. And in that context, I think it makes sense to as someone who was not involved in the detail in the progress report that some of my colleagues here on the panel are, to begin by framing what this is about. The problem that we are trying to solve here is that in sort of broad strokes, the top 500 global firms by revenue showed approximately $3 trillion in book profits after tax last year. And the major ones that I'm familiar with that are the lion's share of that number are paying tax rates less than that paid by a working class household. Now, this situation has been identified by world leaders in the OECD as a threat. And I want to articulate exactly the kind of threat it is. It's a fiscal threat in terms of the loss of fiscal capacity to the world's governments at a time when there is urgent need for that capacity on issues ranging from climate to COVID to dealing with threats to democracy. And speaking of threats to democracy, this situation is a political threat. The deterioration of the corporate tax system, both nationally and globally, is a threat to the legitimacy of national governments and of the global governance system itself. Just to be even sort of sharper, 4 firms, I think some of whom are in this room, Apple, Facebook, Google, and Microsoft, reported $330 billion in pre-tax profits in the last year, covered by their 10Ks, their financial statements. Those are profit rates highly relevant to the progress report. These are profit rates of between 30 and 40% of their revenues for each of those companies. None of them reported paying more than 17% of those profits in taxes globally. Now, the solution here is the 2-pillar outcome of the BEPS process. And I should say that on behalf of the OECD's labor unions, we see this as a historic step forward. And we are very pleased with the work of the OECD and the member governments in getting there. But the problem in relation to Pillar 1, which we're here today to discuss, is that it's a hybrid system that combines unitary taxation with the transfer pricing-based traditional corporate taxation into one amalgam, which is very, very difficult to design and potentially to administer. And the progress report's complexity and opacity, I'm afraid, reflects not the skills and intentions of those involved in it, but the nature of the challenge created by that hybrid system. Now, TUEC has submitted detailed comments about this, but I want to cover essentially 2 principles that we think need to govern how this is done. First, and this is most important, the OECD and the member countries thereof and the signatories to the inclusive framework have told the world that what this is a tax regime that is going to tax residual, the excess profits, the profits over 10% of revenues at a 25% rate. That should be the North Star, the guiding principle of how this document is written. Every ambiguity in the charge you have received should be resolved to realize an effective 25% tax rate on that excess profit. Secondly, that something has to be done about the lack of country-specific information in this process. Because as of today, we do not believe, as the trade unions, it is possible to evaluate the allocation mechanisms in the draft, in the progress report, which appear to be on their face, thoughtful attempts. There's no way to evaluate it without country-specific tax information to compare to identify what the process would do and compare it with the current item. There are 4 specific consequences of those 2 principles I wish to just touch on. The first is that against the goal of 25% taxation, the concept of double taxation, which after all is in the inclusive framework, the concept of double taxation is incoherent. Right? The framework does not envision that Pillar 1 is a cap on corporate income tax. And so the concept of double taxation needs to be reworked in alignment with the principle I articulated and the fact that this framework is not a cap. Secondly, withholding taxes, which is the subject of much discussion in this meeting, should not be deducted at all unless they can be shown that they are a genuinely separate corporate income tax and not a means simply of collecting an already existing tax. To do otherwise would be to give a double deduction. The safe harbor, which is again a subject of much discussion, should be redistributive, not deductible. If it's deductible, you've essentially cut the legs out from under the 25% goal, which the world believes that the signatories have committed to. And finally, the OECD staff should be alert to the threat of reproducing in Pillar 1 the problems that gave rise to Pillar 1, meaning there should be no backward-looking loss carry-forwards. Loss carry-forwards forward-looking should be limited in scope, 3 years perhaps, We should have independently audited financial statements, and so forth. Let me conclude by saying, it is going to be very challenging to complete this process and get national signatories, sufficient national signatories to it. Some commentators have suggested, given the complexity of the document, it's impossible. They may be right. If that's so, or if there are delays, under no case should unilateral measures be eliminated until an acceptable Pillar 1 is completed, nor should Pillar 2, which so much depends upon in terms of the governance of our global economy, nor should Pillar 2 be delayed if there are delays in Pillar 1. I want to thank the OECD and our hosts for giving the TUAC the opportunity to present on this and to be able to speak substantively on this matter. And I'll turn it back to our chair.
Thank you very much. The chair is now faced with the challenge of being 5 minutes late and having 10 minutes of slides, so I will do my usual thing and speak very fast. So first of all, thanks, and you see we have a range of views here on the panel. What I wanted to do is take you roughly through a couple of the key messages we've gotten from the consultation. But before I do that, I can't stop myself from making two comments, perhaps. One is, when you sometimes read the press, they say, oh, business comments are very critical of the OECD. That is not how the OECD sees this. Let me, on record, say, and I said this at IFA as well, I think practically all the comments that we have seen are clearly written in the spirit of trying to make this into a better product, and we are extremely appreciative. The team is going through all of them. We've done this over the last couple of weeks, and we're doing this, and there are many suggestions that are really done in that spirit, and we are welcoming that. We're engaging. We're seeing of how we can do this better within the constraints. We're here in a technical discussion, so we're trying to improve the technical project. I think that's what we can do. So that, I think, is the first point. And then the second point, we hear a lot about complexity, and we're not suggesting that this isn't a complicated document. But at the same time, I think there's two things that we should separate. One is there is the going in complexity, and then there's the operational running the system complexity, and one needs to distinguish the two, right? We are thinking about sort of more formulaic approaches, and you need to keep those apart. When sometimes you apply a spreadsheet approach to some of the intellectual complexity, it looks different from getting your head around it first. And if we also kind of just step back for a second, and maybe sometimes that's useful, if we look at the forest and not so much the tree, then the overall system of Pillar 1 and its basic building blocks, I think, has the support of a wide range of people in the business community and civil society across the board. We are taking 25% over 10, and we're allocating it to the market unless the market already has it, right? So that's one step. I think then we have, and we need to have, a total tax certainty dimension without which this doesn't work for Amount A and for the other issues inside it to stabilize the system. And I think that's the second point. And then we will have to have unilateral measures disappear as part of that same package. So if you look at those elements at a higher level rather than focusing on the specific translation, which will always be complicated. When you think about the current system, if you had never seen transfer pricing, we give you the transfer pricing guidelines, you probably tell us this is very complicated. If we show you FATCA or the CRS, you probably tell us this is all very complicated, and that's all very true. So I think we should think about this like the big picture, what we're trying to do, much appreciative that there's a lot of work in how we do this, room for improvement, clearly there is. And with that, always positive notion, let me go very briefly to an overview of where we are in the comments. So here you see 72 submissions, over 700 pages. You can read this. I can go to the next slide. If we do that, I mean, that's pretty obvious. I guess you can read this again, and you know, in the interest of time, I'm not going to speak much about this. I think we are all here to try to do that, emphasize the importance of stabilizing the international tax framework, and of course there is significant support for the withdrawal and standstill committed on unilateral measures. I think I tried to say this in the introductory comments. If we go to the next slide here, and I'll be quick on this, we will make those slides available so I don't go through, and in some sense I am summarizing what you send us, so this is sometimes of limited use to you. But we have comments on all of the building blocks, the ones that you have seen in the past, as well as the new ones. So, on the main scope provisions, there's a point about the exclusion of domestic-oriented businesses. This, of course, also links sometimes to the multiplier and MDSH. There's some sense here that, there may be certain circumstances in which the package needs to be addressed to avoid results that seem to be somewhat arbitrary, difficult to rationalize, little economic basis. So we hear these comments. At the same time, I think we also hear from Alan about clarity and simplicity, and it's finding the right trade-off between clarity and simplicity, and sometimes accepting results that may not sound intuitive. The extractive exclusion, there's support for a transition phase with request for technical corrections, and I'm just doing the main messages here. If you go to regulated financial services, I guess there is support for the exclusion of reinsurance and asset management, and more questions on simplification, trying to do this through. Revenue sourcing, support for a longer transition phase, request for more specific guidance. I can do the long list of the revenue sourcing questions, not in the time, but there's a lot of technical work that we will be doing with you in trying to improve all of those rules, not just revenue sourcing, but also the exclusions. There's a couple of other aspects on exclusions that we're happy to work with. There's questions on the tax base. I think we'll hear about the tax base also later, I think in panel 3 and some other issues around here. If we go to the next slide, segmentation, I think there's broad support that we limit the segmentation rule to disclosed segments. And I guess if I allow a footnote, that also limits some of the accuracy that we have. If we are looking at a not separated business line global profit number, we will have certain things that could be seen as distortions. And that's part of the system if we want to keep it simple. And then I think also, and this is why we picked the following 2 panels, I think you have a whole host of comments, very constructive, I say it again, on the marketing and distribution safe harbor, as well as on the elimination. We'll hear from Gael and Michael a bit the backstory of how we got to the design of the MDSH that is currently in the public consultation document, and the same for elimination. But if you run through those, and you've of course sent in these comments, so not surprising, there's questions about the metric, whether that's the right metric. There's questions about offsetting and multipliers and percentages, and it should be 100 and not 25 or anything. And then there's, of course, very strong support from across businesses about taking withholding taxes into account, either by running them through the MDSH or having a separate offset mechanism that achieves a similar purpose. If you then go to elimination, again, questions on the appropriateness of the RODP metric for identifying jurisdictions with residual profits, questions on the stability of those metrics and what they might turn out to be in different years. There's broad support for the concept of a de minimis rule. It's slightly different, I guess, if you look at the comments on MDSH. And I guess there's a strong support for the exemption method to eliminate double taxation. If we go then to the last slide, I'll be quick. I think, while we didn't consult on this, still people felt that, make the point that we need a robust framework for withdrawal, standstill of unilateral measures, and a very strong continued support for Amount B. And let me conclude on this then also before I turn it over to Gael on the first panel. And this is coming back to the forest. It is very important, and we can see that when you only see parts, you don't see the whole picture. You've seen parts of tax certainty. Now you see the rules. You're going to see more on tax certainty. You haven't seen the note on the withdrawal of unilateral measures, and it's only when all of them come together and you see how they integrated, you can fully appreciate how that package will work. We are working on this. You will have this hopefully shortly so that we will move on, and of course we will be making changes as a result of this public consultation and the comments. So I think with this, one last housekeeping item. If you do have questions, I think I should have said this earlier, do send the questions. We can send the email address where you should send your questions to tfdeoec.org. We will collect those, make them available to the moderator so that if there is time at the end of the session, then we will take those questions. I think with this, we can then go to panel 1, where my job is an easy one, where it says in my speaking note, invites Gael to take over, and so I shall do this now.
Thank you very much, Hakim. Maybe before I would invite the panelists to come on stage to start the panel. Everyone is on stage, so I should welcome all our participants. This first panel will be about the marketing and distribution safe harbor. Maybe before we start the discussion, let me first quickly go over the structure of this session. So, as the moderator of this panel, I will first give you a brief background on this new animal, the MDSH provision that were included in the progress report, touching upon some of the challenges that the TFD faced in the development of this mechanism, and also the rationale behind some of the design choices currently presented to you. Following this introduction, and that will be the main part of it, the most important and interesting part of this panel, we have 5 speakers who will share their views on the MDSH mechanism. And we will also invite panelists to discuss their views on possible interaction with withholding taxes levied by market jurisdiction when applying the MDSH. So each speaker will have about 10 minutes. So for this first panel, I am pleased to welcome and introduce to you Thomas Quatrevalet. Thomas is Deputy Head of Tax of Air Liquide. Air Liquide is a French M&E, leading in its domain, for those who don't know it. Then we will have Alison Lobb, partner at Deloitte. Tom Rosser from Microsoft Corporation, which I don't need to present. Abdul Chaudhary, Senior Program Officer for the South Center. So the South Center is an intergovernmental organization gathering several developing countries. And last but not least, Monika Wünemann. Monika is Head of Department Tax and Financial Policy at BDI, BDI meaning Bundesverband der Deutschen Industrie. So if my German is okay, I think it means that she's representing here the German business today. After this discussion, if time allows, we will have a short Q&A session. So as explained by Arim earlier, you will have to send your question to a specific email address. If you would like to pose a question to one panelist, you need to send your question to the Secretariat, but Arim said that as well. So I will go directly to the introductory presentation of the MDSH. In simple terms, it's very easy to understand in terms of rationale because it's a mechanism aimed at addressing double counting. So we all understand the need to address double counting by adjusting the allocation of amount A for market jurisdiction that already have taxing rights over the group's residual profits. So it looks simple, but to understand the provision in the progress report that seek to deliver those results, it might be useful to take a step back and recall the history of the work conducted so far by the TFD. So consistent with the 2020 blueprint, the inclusive framework initially explored the feasibility of various entity-based approaches to MDSH, including the market connection test that was mentioned in the blueprint. However, due to the conceptual and practical challenges and the lack of support also, we must say that, for such approaches, because we have built the rest of the pillar on a jurisdictional basis, the IF concluded that an entity-level approach would not be the better fit for the MDSH. So that's one of the explanations. The key challenges included, for instance, complexity and risks of disputes associated with identifying profits attributable to market and distribution activities and distortions arising from mismatches between an entity approach and other features of amount A. For example, jurisdictional level calculation for elimination of double taxation. So that's really the key explanation why we didn't follow that path. This ultimately led to the development of an architectural framework that is both jurisdictional and quantitative in design, as reflected in the progress report. And while there is a broad support for a jurisdictional approach in the IF, there are still, and that's normal at this point of time, different views amongst delegates on particular aspects of this approach, and this is clearly flagged also in the progress report. You will see that with the square brackets in some part, and of course with the footnotes, which are always very useful in the OECD reports, even if they are written in very small characters, but they are always very important. Now, if one tries to summarize quickly the key feature of this jurisdictional approach of the MDSH, I would flag the following. So the mechanism first uses a return on depreciation and payroll, RODP, based metric to determine whether a jurisdiction has residual profits first, and if so, the quantum of residual profit on a jurisdictional basis. The progress report currently refers to the higher of two RODP-based metrics, being the elimination threshold RODP, which is the equivalent of the group return on 10% converted into a group RODP percentage, or alternatively 40%. The MDSH also includes an offset percentage, which for the moment is characterized by a letter Y, so it is to be determined, which aims to address the concerns of countries that not all residual profits located in a given market jurisdiction are necessarily relevant for double counting purposes. The MDSH will, of course, interact with the elimination mechanism, with the proposal that the MDSH adjustment amount, or multiple of that amount to be determined, would be excluded from the available pool of profit for elimination purposes. So that's really the connecting point. And there is also a de minimis profit threshold, such that the smaller jurisdiction with profits falling below the threshold would be out of scope of the MDSH. So you have noted that in particular the metrics are in brackets or characterized by a letter, so we have to continue to discuss on those issues. Very last important to flag is the question of withholding taxes, where different members have, at this point of time, different views on whether and how these taxing rights would interact with amount A. Is it a question of double counting, double taxation? And I understand from comments received that stakeholders also have strong views on that matter. So it was interesting to see that many stakeholders have proactively provided inputs on how to specifically incorporate withholding taxes in the MDSH or in the elimination mechanism. And this panel, I guess, will obviously be an opportunity to share those inputs. Have been quite long, but it's now time for the panelists to discuss all these elements. So without any further delay, et en français, j'invite Thomas.
So I'm going to ask Thomas to start. Well, thank you very much, Gail.
Secretary of the OECD and the task force for allowing this discussion today. We think it's very useful that we can discuss the responses that have been made to the progress report. If you could show the first slide, please. The next one. Thank you. We wanted to discuss today about some potential issues that have been identified by MNE with the way the MDSH works. But before that, I think it's useful to remind ourselves of the policy intents of Pillar 1 and of the MDSH. It may seem very obvious to some of you, but in fact, when you look at the outcomes of the modeling that some MNE have now done, it's important to have those things in mind. So, first of all, the amount A, as I understand it, its purpose was to reallocate a portion of a group's profits to the market countries where the end consumers are located and they are associated with those profits. And it targeted situations where this profit was not in those countries but was somewhere else, and it was viewed that standard transfer pricing rules could not address this situation. At the very same time, the MDSH was suggested, and the purpose was really to remove the complexity of amount A in those cases where the residual profit is already in the market countries, and therefore also avoiding double counting of the same profits, because there would be no need to allocate amount A in those instances. So with the progress report being issued, and we are thankful for having now a more comprehensive view on the way the rules operate, many groups have started to model the way it works. And in fact, in many situations, we are seeing that the MDSH does not operate as intended. In fact, there are many situations where there is still an amount A allocation to a market country, despite the fact that the residual profit, or at least a very large part of it, is already in the market country. Why does it matter? It matters because if you are still allocating amount A in this case, you will take some profits elsewhere, but those profits won't have anything to do with the profits of the first market. So you will end up with market-to-market allocations and market countries subsidizing others, basically, without any sound policy rationale. And why do we have those outcomes? Well, it has to do with the mechanism of the MDSH itself, in fact, because the way it works is you are comparing a group threshold return on depreciation and payroll with a country-by-country profitability. But the reality of M&E is, in fact, that the profitability may significantly vary from one country to another, and this can be due to difference in cost levels, of the amount of capital investments and their maturity, and even the size of the market can drive big differences in profitability. So in those situations, the MDSH will not offer a full relief, despite the fact that there is, in fact, significant residual profit in the market country. And I just want to briefly mention that the Y% discount and the de minimis rule that Gaël mentioned would very much worsen those distortions in those instances. And this is one of the reasons why the business community is struggling with those concepts, because we fear that it will lead to double counting of the same profit. So if we move to the next slide, please. An extreme example of those distortions is the case of decentralized local business models. I'm going to elaborate a little bit on that, but the distortions I mentioned are much broader than that. It's just to give you an extreme example of this. In those business models, which are in fact not so rare within M&E, affiliates are acting as entrepreneurs within the limit of their own countries, and they are keeping the residual profit or loss, because we know for transfer pricing purposes the entrepreneur is entitled to that residual profit, or loss, because it can happen as well. The production and the selling is predominantly local, and there are very few cross-border intercompany transactions, mostly management fees and IP royalties, because there are still some central functions, of course, at the level of the parent company of the group. But overall, it's very small. If I take the case of my group, for example, intercompany cross-border transactions only represent 15% of the external turnover of the group, which is very, very low. More centralized organizations would have intercompany transaction representing 100% of the external turnover, so it's very low. Those business models are clearly not the target of Pillar 1. You can see why. They already allow the residual profit to be kept by the market countries. Nevertheless, when we try to model the rules and the MDSH, we realize that there will be significant amount A allocations from one market country to another, just for the reasons I described earlier, because of those differences in the metrics between the group metrics and the country-by-country metrics. And it leads to very counterintuitive outcomes. Some groups are finding that major Asian countries are surrendering amount A to the US and Germany, for example, without any sound business or policy rationale. So if we move on to the next slide. The good news, I would say, is that for those specific cases, there is a solution. And in fact, this solution was described at length in the 2020 blueprint. And it is the local business exception, sometimes also called the domestic business exemption. This exception is just there to say, with some specific fact patterns, you can avoid any amount A allocation, because the way the group is organized makes sure that there can't be any shifting of profit elsewhere than in the market countries. And we think we could use very simple criteria It's easy to check whether a production and a selling takes place within the same country. It's also easy to check the amount of intercompany cross-border transactions because it's something that is already in a country-by-country report. We can say, for example, we could set a maximum of 20%, but it's just an example. It's to be discussed. It's an objective criteria, and it would remove complexity for the groups which are concerned, but also more importantly, it would remove very unintended outcomes which were not the purpose of Amount A, we think, and which wouldn't help, in fact, stabilizing the international tax framework, which is also one of the objectives of Pillar 1. So the business community believes that this should be implemented preferably as a scoping test, meaning that all the turnover and the profits which meet those criteria would be excluded when we measure the level of turnover and profit for the scoping exercise. If that is not possible, this could be a complementary test to the MDSH to be discussed. But we really believe that without this instrument, there will be counterintuitive outcomes. And I have to say, I understand that the scope of Pillar 1 will extend in the future. Maybe the thresholds will go down. So as it goes down, you will see more and more businesses organized in this manner. So it's time to think about it before there are many groups, many groups in this situation. I want to say that there are other types of tools that could be used to address other situations, such as an overall cap of the reallocation of Amount A on top of the MDSH, but I won't elaborate because other panelists, will discuss about it. And finally, moving to the next slide, I want to briefly touch upon the subject of the withholding taxes that was discussed previously. The business community overwhelmingly believes that withholding taxes on royalties, services, and interest are a way to tax the residual profits in the source country. So it's pretty clear for the business community that withholding taxes have to be taken into account in the Amount A equation and in the DMDSH. And again, there have been some suggestions to do that. One of them is to deduct a grossed up withholding tax amount from Amount A, taking into account the local corporate tax rate of the receiving country of the receiving entity. We really believe that this subject needs to be factored into account. Otherwise, we fear that withholding taxes will proliferate, and again, that will go against the objective of stabilizing the international tax framework. I'll stop there, and thank you for listening.
Merci beaucoup, Thomas. C'était extrêmement.
Thank you very much, Thomas. That was very clear.
The second panelist, Alison Loeb from Deloitte.
Good morning, good afternoon, everybody. Thank you very much, Gaël and the TFD, for the opportunity to discuss some of these points and challenges. Apologies that I cannot be with you in person. So if we could move to the first slide, please. Thank you. Following on from what Thomas has already explained, one of the challenges that businesses are going to have to deal with in practice is determining the profits that arise locally versus those profits that arise centrally. And we agree with Thomas that there is potential for distortions here between different businesses and different sectors, and also potentially within businesses as well. The particular challenge is where business models are decentralized, and this is going to mean that businesses are going to have to determine using the rule set out in the Amount A base for where the entrepreneurial profits arise. And this can be challenging because those entrepreneurial profits in some cases can and do arise in market countries. To follow on from the example that Thomas gave, another example would be franchise models where the franchisee shares in the entrepreneurial profits with the franchisor. Also, as Thomas said, the amalgamation of profits across the group mean that different activities with different profit margins in different countries will be pulled together. And this causes challenges, in particular, where there are local country differences in profitability, which can arise for many reasons. There are also questions around the cost base and differences in cost base between different groups or between different parts of the same group. The Pillar 1 rules as suggested use payroll costs and depreciation costs as proxies for substance, as proxies for people activity and for tangible assets. This raises questions, though, when you're looking at profitability and sharing profits amongst group members, as to whether other, perhaps even all, local costs should be taken into account in the calculations. An example might be where a group has payroll costs and depreciation costs in one jurisdiction, but that jurisdiction is also perhaps paying a royalty to another group company, and that cost is not reflected in relation to their profitability. The other point to note here is that commercial business decisions will lead to differences in outcomes. One example here is that groups that outsource certain activities will have a different answer from those that decide to operate those activities in-house. For example, the payroll costs and the depreciation costs for those that insource are likely to be higher than the payroll costs for those that outsource. Instead, those that outsource will have similar costs included in other costs or in cost of sales that will not be taken into account. And these kind of questions are difficult to deal with, but nonetheless, they reflect some concerns that the business community has around potential distortions between commercial business models. If we move on to the next slide. In relation to withholding taxes, and obviously much has been said on this already, there are challenges that need to be addressed. The political agreement from October 2021 said that the marketing and distribution safe harbour should apply where the residual profits of an in-scope multinational are already taxed in a market jurisdiction. And this raises questions in relation to withholding taxes, because source taxation, such as withholding taxes on royalties, already taxes the residual profits of a group in the market country. And to ignore withholding taxes could lead to double taxation in the market countries. At the moment, the proposed marketing and distribution safe harbour currently only considers profitability and not current levels or locations of taxation. And there isn't a mechanism for profits that are already subject to foreign taxes to be taken into account differently. Perhaps the simplest and perhaps most practical solution would be to supplement the marketing and distribution safe harbour proposal with a rule that would allow withholding taxes to be levied in line with domestic law and tax treaties, but to credit that local withholding tax against any local amount A liability to mitigate double taxation. This isn't the only solution. There would be others that would involve reallocating profits that have already been subject to tax locally, but perhaps it is the simplest one to deal with. What this would mean is that the higher of the withholding taxes or amount A tax would be payable in the market country. If we move on to the next slide. Complexity. Akim referenced complexity at the start, and clearly the significance of the changes proposed under amount A will inevitably mean that this is complex. But just to provide some thoughts. I think particular complexity arises in relation to the marketing and distribution profit safe harbour, and also its interaction with the elimination of profits and the relieving jurisdiction rules. Examples and guidance would be helpful, as would areas for simplification to reduce costs for business and administrative costs for tax authorities wherever that might be possible. And I think it will also be helpful to provide mechanisms that allow for a consistent application across different activities conducted by the same group, even where that applies as an extra adjustment. In the rules, there is a suggestion that the reduction of the amount A profits under the marketing distribution safe harbour might be at Y%. And it would be useful to understand the rationale for anything other than 100% in this instance. Again, understanding the rationale for the selection of the 40% rate as being a suitable return on payroll and depreciation would also be helpful. And then finally, understanding the interaction with the relieving jurisdiction double taxation mechanisms will also be important. And I know that the next panel is going to discuss that in more detail. Finally, just to echo some of the comments that Akim made at the start, that stability of the international tax framework is, I think, what everyone is seeking for the long term. As a result, more clarity and the rationale behind decisions, I think, would help for everybody to understand why and how the rules are going to operate as intended. This includes understanding not only the rules themselves, but also the principles and the reasoning behind the mechanisms selected. We also agree that dispute resolution and early certainty for the groups in scope of Amount A will be not only helpful, but also necessary, although will not in and of themselves be a replacement for legal and treaty obligations that businesses and governments will need to apply. Thank you very much.
Thank you very much, Alison. Then let's move to the next speaker, Tom Rosser from the very well-known corporation, Microsoft.
Thank you, Gail, and thanks to the Secretariat for inviting us to this important consultation. We hope there'll be future consultations as we learn more about the forest relating to tax certainty, to withholding taxes, tax administration, and other critically important issues to ensure that not only taxpayers can comply, but tax administrations can administer these rules. While many key political and technical issues must be resolved, we support efforts to negotiate such an agreement based upon taxing net income, eliminating double counting and double taxation, and providing meaningful tax certainty for both taxpayers and tax administrations. As Alison just mentioned, the tax certainty piece will be very critical. Before I mention the marketing distribution safe harbor notions, I'd like to just note, I think many in business are still very concerned with the revenue sourcing approach in the progress report. I think a lot more work needs to be done there to make it actually workable, once again, for both taxpayers and tax administrations. And the business community believes that there should be advanced certainty. At least from our perspective, we think there should be an agreement on methodologies in advance of the year in question, not afterwards, but in advance of the year in question for revenue sourcing, for segmentation, for withholding taxes, for the marketing and distribution safe harbor, as well as the relieving jurisdiction. We believe all those methodologies should be agreed in advance. And then I think that will lead to a much smoother and more productive and effective Pillar 1. So that's it on withholding, on revenue sourcing. As others on the panel mentioned, the purpose, the objective of the marketing distribution safe harbor is to adjust the allocation of Amount A for market jurisdictions that already have existing taxing rights over the group's residual profits. And from our perspective, the marketing distribution safe harbor is absolutely critical to the success of Amount A. We believe Amount A should be reduced or eliminated to the extent jurisdictions are already taxing residual profits via the transfer pricing, withholding taxes, or other taxes. The rules should not incentivize countries to impose new withholding taxes or make aggressive transfer pricing adjustments where Amount A already provides an internationally agreed allocation of residual profits. Given the objective of the marketing and distribution safe harbor, we were surprised to see various complex and burdensome limitations included in the progress report. From our perspective, to prevent double counting, we recommend elimination of several of these elements in the marketing and distribution safe harbor calculation. As others mentioned, the arbitrary amount Y limitation just seemed to be a way to create double counting. We believe amount Y should not even be referenced. If you put it at 100%, then there's a possibility in years in the future that 100% will be dialed down to create double taxation. So we recommend the removal of amount Y. As other commentators have mentioned, the use of return on depreciation and payroll can vary significantly between taxpayers. It seems antiquated and does not reflect all cost in a market jurisdiction. And then there's this notion of the higher of 40% threshold. I think business needs additional information regarding the rationale behind that 40% threshold. As noted in the Business at OECD submission, it's also critically important to the design of Amount A to consider withholding taxes when applying the market and distribution safe harbor to avoid over-allocating residual profits to market countries and, in turn, under-allocating profits to other countries where the balance of the multinationals' activities take place. In addition, Business at OECD noted in their comment paper that withholding taxes need to be considered in the elimination of double taxation, since withholding taxes affect the amount of taxes actually paid by entities in the relieving jurisdiction. To the extent that the return on depreciation and payroll is retained, we believe it should be expanded to include amortization of acquired identified intangible assets, for example, other than goodwill. We don't agree that a 10% return on sales is the correct threshold for determining a non-routine return. The exclusion of cost of outsourced activities, I think Allison mentioned that in the RODP base, can also create significant differences between groups. With regard to other potential ideas to smooth out some of the distortions from the progress report, it's our view that if inclusive framework members agreed to a reallocation of 25% over 10% profitability threshold, we also recommend that Amount A should be capped where the total amount of profits allocated to market jurisdictions under Amount A, the transfer pricing rules, and withholding taxes exceed 25% of total system profits, thereby removing the incentive for tax authorities to take aggressive transfer pricing positions and to impose withholding taxes. System profits are locally sourced sales multiplied by the group's global margin. Alternatively, another approach, as we noted in our December 2020 comments, we recommended two possible approaches to provide a ceiling for Amount A. One approach would be to compare the value-added marketing and distribution fixed return, Amount B, which is still under consideration, to the profits already allocated to the marketing and distribution affiliate under the arm's length principle. If the arm's length principle allocation exceeds the marketing and distribution fixed return, then the excess should reduce or eliminate the Amount A allocation. A second approach would be to limit marketing and distribution profits in the jurisdiction to no more than the sum of an Amount B fixed return allocation for the local market jurisdiction affiliate PE and the multinational group's Amount A formulaic reallocation. If the arm's length principle allocation is less, then there would need to be a top-up via Amount A. If the arm's length principle allocation is equal or more, then there would be no additional Amount A reallocation, and the existing allocation would be adjusted to eliminate any excess. With regard to the multiplier included in the progress report, I think business needs a better explanation to be able to better model that. From our perspective, we don't see any possible multiplier doing anything other than possibly altering the tiering with a very high multiple. Also, since Amount A is delayed until 2024, several groups have suggested it may be appropriate to accelerate work on Amount B, and that include the distribution of services. As noted in our December 2020 comments, Amount B is intended to approximate results determined in accordance with the arm's length principle. Given the various comments and discussions around Amount B in late 2019 and the lack of clarity on possible Amount B and then the amount C returns, we thought it'd be helpful to commission KPMG to perform a fact-based economic analysis on actual arm's length returns to limited risk distributors and value-added marketing and distribution activities across industries, geographies, and levels of profitability. KPMG's analysis found that regardless of industry, geography, or profitability of the companies, the returns for sales, marketing, and distribution activities are within a fairly narrow band and decreased as a share of system profits in highly profitable companies. The KPMG analysis found that limited risk distributor returns, the median was about 2.5%, with value-added returns at about 3.6%. And we hope that would be helpful to the discussions regarding amount B. We look forward to obtaining more information, as I mentioned before, on the various building blocks. We do hope that there's another consultation on the next set of documents to be released. And then once all the building blocks are in and there's been an opportunity for comment, we hope there's an opportunity to have a robust consultation on the full amount A package. Thank you.
Thank you very much, Tom, and for confirming that you really like the public consultation process. Promised there will be another one. Now let's give the floor to Abdul Chaudhary. Abdul is a Senior Program Officer at South Center.
Thank you, Gail, for the opportunity for the South Center to give its views at this public consultation. As was mentioned, the South Center is an intergovernmental think tank of developing countries. We have 54 member states from Asia, Africa, and Latin America. And in my comments, I'll go over some of the concerns of delegates from developing countries with regard to the marketing and distribution safe harbor and withholding taxes. I'd like to begin by saying that the developing countries have already compromised quite significantly through the negotiations at every stage. I mean, right from the unified approach, where the significant economic presence proposal was sort of taken off, and up to when the scope was severely restricted to only around 100 companies. And this continues, and it's reflected in the revenue estimates, which were, by the OECD's own account, going to give very, very limited amounts of additional revenue to the developing countries. At this stage, we would like to highlight the call for country-level revenue estimates once the amount A rules are stabilized, and this should be a prerequisite for any decision making by the members of the inclusive framework. At the South Center, we came out with our own set of revenue estimates, which I invite everyone to look at, and found that when compared to the United Nations alternative solution of Article 12b, amount A provided 2 to 5 times less revenue. So this is already a solution which is going to give a very small amount of revenue to developing countries. Now, when we look at the specific issues of the marketing and distribution safe harbor and withholding taxes, these are quite fundamental issues which are being discussed, and in some ways it could be considered a deal breaker for amount A. And I would like to highlight that pushing excessively hard on these issues may force developing countries towards a wall and force them to reject the deal, which would result in a continuation of unilateral measures and digital service taxes. So this is something which those representing the interests of the developed countries should be quite careful about. In all of the discussions about simplicity and stability which have been mentioned earlier, excessive concessions through these carve-outs make the system more complex and would undermine the stability of the system. Now, coming to the marketing and distribution safe harbor specifically, it must be mentioned that there was no mention in the July and the October inclusive framework statements of expanding the scope beyond marketing and distribution. So the present calls for having all activities covered under something which should be strongly rejected. I would agree with the previous panelists that there needs to be a look of the criteria of what would be used to define marketing and distribution residual profits. The use of the RODP, as has been mentioned, is inappropriate because often marketing and distribution entities have low assets and payroll costs, and this would end up having a counterproductive result because what are essentially routine profits in developing countries would be categorized as residual profits, and instead of receiving amount A allocation, they would end up losing out on the amount A allocation, and this is something which may really push the developing countries to reject amount A. And it would also defeat the very purpose of amount A, which was to result in increased revenue collection for the developing countries. We would like to express our support for the alternative proposal put forward by the internal group of 24, that a composite metric based on a return of 30% of global profit margin on sale and 40% RODP on a jurisdictional basis can be considered to be an alternative. There's mention to a multiple of the MDSH adjustment in the text. This is something which should be completely removed. And the de minimis threshold, it was concerning to see that there were calls to questioning the existence of the de minimis threshold. This, we firmly reiterate, should be there, and the threshold should be as high as possible. Now, coming to the issue of withholding taxes, it must be reiterated that there was no mention of withholding taxes in previous statements of the inclusive framework. This is something which has been added in. This is something which is not politically agreed upon. And I would like to strongly reiterate that this is something which may be considered as a deal breaker for many developing countries, because not only would it significantly reduce the amount allocation, it could actually result in an erosion of existing taxing rights. And this is an issue which is taken very seriously. It should not be underestimated. One of the views is that this would basically imply an adjustment of 100% of a withholding tax for amount, which is a tiny portion, 25% of residual profits. If developing countries had known from the beginning that this withholding taxes would be adjustable or creditable for amount A, they would have demanded a far higher quantum of amount A than 25%. And if you may recall, there was a proposal in the Pillar 1 blueprint for a sliding scale, which would basically increase the residual profits depending on profitability up to 50%. So this is something which has been introduced at a later stage, which goes against the political agreement by the members of the inclusive framework. And it is something which is really quite strongly opposed by developing countries. Going forward, the argument of double counting which is made on withholding taxes is also flawed, because amount A is a new taxing right, whereas withholding taxes are applied on existing taxing rights. So the two are mutually exclusive. Withholding taxes are applied through existing bilateral tax treaties. Amount A will operate through a multilateral convention which sits on top of the existing taxing rights. Then the second argument is that this is a false analogy, because a withholding tax is a collection mechanism, and as was also mentioned by Damon Silvers earlier, it is not a tax in itself, it's a collection mechanism for an existing tax. So to equate or to make an analogy with amount A is incorrect. The third assumption of double counting is that withholding taxes, it is incorrectly assumed that they would precisely target the quantum of amount A, which, as mentioned, is only 25% of residual profit. So the adjustment would be 100% of a withholding tax for something which is basically 25% of residual profits, and it's incorrect to say that this would be accurate in most cases. Further, it must be mentioned that no jurisdiction allows credit and refunds foreign withholding taxes when it does not tax a corresponding income. So the expectation that this would be done is something which is not, or which is very rarely done in existing tax practice as well. So the demand by developing countries, which has been really made quite strongly, is that withholding taxes must be completely removed from the amount allocation and elimination mechanisms. And I would like to reiterate once again that in designing the technical rules, excessively stretching each and every possible rule to minimize in practice how much amount A will be allocated to developing countries would increase the likelihood that amount A would be rejected and lead to a continuation of unilateral uncoordinated measures like digital service taxes. Thank you.
Thank you very much, Abdul. And then last but not least, let me introduce Monika Wünemann from BDI, so the German business representative.
First of all, I want to thank the OECD for inviting me to talk about the progress of report of Pillar 1 from the perspective of the German industries. It's a great opportunity to discuss the work of this large project with interested public. I will get to the marketing and distribution safe harbor in a minute. Before that, please allow me some general remarks about the OECD Pillar 1 approach. As we know, the policy goal of M&A is to allocate parts of the profits of the most profitable and biggest companies to market states where those profits are earned. We believe the project has two central and significant difficulties. First, there is the challenge of data collection. How do we identify exact revenue streams in the market states? Revenue sourcing is a central component here. We are afraid that this will result in a bureaucratic monster. At this point, simplifications are needed. They need to be implemented in a legally secure manner between the states. Time-consuming and costly disputes must be avoided. Second, the amount A allocation creates the risk of double counting of profits and their double taxation. This must be eliminated at all cost. Amount A must be harmonized with existing transfer pricing systems so that no distortions arise. The lowest possible administration burden has to be ensured. Also, a strong legal certainty across the participating countries has to be achieved. Let me now come to the marketing and distribution safe harbor. We believe that it can play a critical role in this regard. However, it needs to be well designed. We understand that the OECD has not yet finalized its work on this rule. We therefore welcome the opportunity to provide some points for consideration. We see the MSH rules as a measure to prevent double counting of already allocated and possibly already taxed profits to market countries. For this purpose, it is essential to take into account the withholding taxes already paid in the market state when allocating amount A. This applies also to the general transfer pricing system. What we see right now in the progress report is a MDSH rule that does not take into account withholding taxes nor the transfer pricing system. Since the work is ongoing, industry expects that withholding taxes will be considered in the MDSH residual profit allocation accordingly in the final version. Moreover, the proposed MDSH formula is not fully understandable to the business community. One of the key components of the safe harbor rule is the return on depreciation and payroll, RODP. It aims to prevent double counting of the same tax basis. We do not understand why not all residual profits are included in the safe harbor rule. Profits that have already been included once must be completely excluded from amount A. Otherwise, the Pillar 1 project does not achieve its goals and the business community loses its trust in the proposed system. In addition, the current system does not take into account local business activities of companies. These are companies that already operate in a local market and generate a very high rate of return that is not achieved in other locations. Thereby, they fall in the scope of amount A just because of a certain local profitability. Such poorly local business activities must be taken into account. If this is not the case, one would not understand why they should indirectly affect amount A distribution to market countries. Take Germany as an example. German industry often operates locally in different countries. In doing so, the MDSH and the REDP also take into account that fixed assets depreciate. This can be due to technical reasons or due to special reasons. An example could be politically intended abbreviated special depreciations. The latter then appear with less expense in the income statement for the market state. Thereby, they benefit less from the RODP, even though they produce locally and have invested in equipment in the market country. In summary, there is work ahead of us to design amount A in an appropriate manner. It is very important to avoid double counting and double taxation of residual profits. The approach chosen must be manageable, must be ensure legal compliance, and must not involve highly complex calculations. Withholding taxes already paid on residual profits must be fully taken into account. We are hopeful for a comprehensive proposal from the OECD. Thank you.
Thank you very much, Monica. That was clear. Vielen Dank. We are coming to the end of the presentation made by the panelists. So I would like to thank all the speakers for their comments. They were clear, not all going in the same direction, but that's also reflecting the diversity of this discussion and all the stakeholders concerned by this topic. Now I turn to Dr. Kroes to see whether there are some questions from the room.
You were extremely efficient. We actually do have time for questions. Now, maybe I start with one question, and these questions, I don't know who wants to take them. I guess one question coming up here to the panel, and I guess you can all speak to that if you wish to. If you had sort of the 2 or 3 wishes in redesigning the MDSH, you know, what would be your wish list? I don't know where I start.
No more than 2.
Okay, France was restricting it to 2. It's a very small Christmas.
So once again, as I mentioned, we would recommend the elimination of Amount Y. We don't think RODP is the appropriate mechanism, and then the 40% higher of limitation, we didn't quite understand the rationale behind that. I think we would suggest moving to a cap to prevent distortions. And then finally, we think moving, as I mentioned before, if Amount B is to come back or to have a fixed return based upon return on sales.
I think for me the most important thing is to have systems within the rules that take into account business models which already allocate the residual profit in the market countries, because I feel that a simple metric approach will not work for those instances. So having something that effectively avoids double counting for those cases would be something that would really help improve the rules and avoid very counterproductive, as I said, outcomes and unintended outcomes in light of the policy intent of Amount A.
If I could just reiterate that the idea of the marketing and distribution safe harbor should not in practice mean a reduction of Amount A allocation to developing countries, but rather it should mean increased taxing rights and tax allocation. So the G24's recommendation for a composite metric based on a return of 30% of global profit margin on sale and 40% RODP on a jurisdictional basis.
That'd be an interesting wish list to do all of this together, but maybe Monica.
Thank you, Achim. As I said before, the consideration of the withholding taxes is the key point of the German industries. But let me give another suggestion. For purposes of simplicity, we recommend that the fixed rate of return of Amount B could be used as a reasonable alternative to the proposed approach. To eliminate any doubt, we recommend that Amount B replace the existing MDSH criterion of RODP, but we do not recommend a fallback metric that can be included as another factor in the higher of rule. This would only lead to over-complex rules.
Well, thank you. Since we still have time, I have a practical question in mind. Most of you, except Abdul, said that withholding tax should be taken into account in the system. But how do you reconcile the fact that withholding tax are imposed on any type of payments which could be representative of not only residual profit, where Amount A is seeking to tax part of the residual profit? So practically, how could we design that?
So I didn't quite hear it all, but are you suggesting everything other than withholdings on dividends, or are you focused on a particular type of withholding?
For instance, withholding tax on services is quite it can exist, it can be even authorized by some treaties. How do you separate the part which would represent a residual profit and the rest which is not?
So I guess I look at it differently. If I go back to the objective of the amount A, the notion was if you already had, were taxed in a jurisdiction already, there shouldn't be double counting. So I would view that as part and parcel with with withholding tax, the current arm's length standard principle that is being left in a jurisdiction, and I would look at it that way.
So thank you very much, Tom. So I think we are perfectly on time now to summarize. So thank you all for this very constructive participation. It was also very clear, and as I said, it's quite logical and expected at this point of time that not everybody agrees on some of the issues with regard to the diversity represented around this table. But as Arim said, the purpose also of the public consultation is to take on board and to reflect back at the TFD level on the inputs which has been given by the public consultation, which has been received. So we understand also the need to better explain maybe why we have chosen to use RODP to be a kind of translation of the 10% return on sales threshold, and it's not a new threshold, it's a way to convert it. We also have to continue our work, and we take your inputs with regard to should Y exist and should Y be less than 100%, and we take completely on board your comments, which are not a surprise to us. And also on the withholding tax, the clear message received by the business that it is a matter of concern for them, but also taking in consideration, as you can hear around the table, that it is a broader discussion which is difficult at this stage. Thank you very much. With that, I think we can do a pause unless you want to say something else. So thank you to you all. Thank you.
So I will follow the wise counsel of the chair. There's a break until 2:15. So if you could be back in your seats, I think it's 2:15. It's half an hour. Then thank you very much also on behalf of the Secretariat for the panel. Thank you. This one here is really easy for me. I invite the panelists to take their seats. They've all done that, so it's an excellent panel already. And then I need to hand over the floor to Michael Plowgen, who hopefully has had breakfast and can hear us, who will be the moderator for this panel and also introduce the panelists. So over to you, Michael.
Thanks, Akam. Yeah, I had breakfast a long time ago. Hi, everyone. I am pleased to moderate this second panel on the elimination of double taxation. So this panel will follow the same structure as the previous one. As moderator, I will give you a brief background on the elimination of double taxation framework that was included in the progress report, touching on some of the challenges that the TFDE faced in the development of the mechanism and the rationale behind some of the design choices. We then have 5 speakers who will elaborate on their views on the elimination of double taxation in about 10 minutes each. For the second panel, I am pleased to welcome Frank Lerat, Global Head of Tax at Sanofi, on behalf of BIAC. Quinn Huynh, a principal in the Washington National Tax Practice at KPMG. Guy France, the Vice President and Head of European Tax at Sony, on behalf of Kaiden Ren. Vijay Pandya, Direct Tax Head at Tata Consultancy Services. And Rick Miner, Vice President and International Tax Counsel at USCIB. After the panel discussions, as with the last panel, if time allows, we'll have a short Q&A session. So as a reminder, if you would like to pose a question to one of the panelists, you should send your question to the Secretariat with your name and organization, as well as the name of the panelist it is directed to, if relevant, to the address shared earlier, tfde@oecd.org. And Ahmed or I will pick some of those questions to share with the panelists. So having gone through the logistical details, let me turn to the background on elimination. Amount A reallocates taxing rights. It doesn't create new income, and we don't intend to create double taxation. So we need an elimination mechanism to coordinate Amount A with the existing allocation of profits. And the October statement established two core principles on which the mechanism to eliminate double taxation will be based. First, the entity or entities that bear the tax liability will be drawn from those that earn residual profit. Second, double taxation of profit will be relieved using either the exemption or credit method. So the first key question the TFDE had to address was how to identify entities that earn residual profits. And after weighing several options, the TFDE concluded that the elimination mechanism should operate on a quantitative and jurisdictional basis. And this really reflected concerns with the conceptual and practical challenges associated with a qualitative approach to identification. For example, if you use an activities test, that would require an M&E group and tax authorities to review the activities of hundreds or possibly thousands of entities and would be difficult or impossible for tax authorities to verify. Moreover, there was a concern that a qualitative test would set up endless fights among in-scope groups and tax authorities over which portion of profits in a jurisdiction are residual profits. It's like asking which are blue profits or green profits when they're all sort of bluish green. And this is a difficulty both for elimination and the MDSH, and as Gail alluded to in his question at the end of the last panel, the same question arises for withholding taxes. How do you tell whether any particular tax is on blue profits or green profits? And delegates discussed this issue at length and ultimately landed on an RODP-based metric to identify residual profits in both elimination and the MDSH. Now, we understand that there are challenges in applying the RODP in some situations, and I know our panelists will discuss some of those. But I want to provide some background on why the RODP was chosen. First, delegates believed that RODP is an indicator for return on substance, effectively. It takes into account the contributions of both capital and labor to an entity's profits. Now, we received a number of comments that said some groups are more asset or labor intensive than other groups, so RODP will treat different groups differently. But the way the calculation works, RODP is generally measured against the average RODP for the group, which means that it takes into account the profile of the particular group. In other words, you're generally comparing the group to itself, not to other groups. Second, delegates were of the view that tangible assets and employees are generally less mobile than intangible assets or other types of assets or expenses. So basing the measure on tangible assets and employees makes it less likely to be impacted by intercompany transactions. Finally, RODP was decided to be measured on a jurisdictional basis rather than entity by entity, because employees and tangible assets might be easily moved between same country entities or in a structure that concentrates employees and tangible assets, and that can increase the risk of distortions. Finally, I want to echo a bit what Akam said earlier about complexity, which is really a valid concern and something that delegates have been very focused on, even if it's hard to tell that sometimes from the documents. Specifically, I think what would be helpful in this discussion is to distinguish between different types of complexity. There's no doubt that the rules describing the elimination mechanism are convoluted. Multiple tiers with a waterfall allocation for one and pro rata allocation for others. I've said this before, if you had a blank sheet of paper, no single jurisdiction would have written the rule in the progress report. But the elimination mechanism was heavily negotiated and represents a series of compromises among jurisdictions. And I want to distinguish that type of conceptual complexity from complexity in applying the rule. To apply the rule, a group needs to measure its elimination tax base in each jurisdiction. And that certainly might be complicated, but it's necessary for any elimination mechanism and is similar to the exercise for Pillar 2. The group also has to measure its depreciation and payroll in each jurisdiction. And again, that might not be easy, but it's at least related to the exercise that groups will have to do for Pillar 2 purposes. So I hope that when commenters talk about complexity, they can say which kind of complexity they're talking about, what gives rise to that complexity, and how it might be ameliorated. So again, I just want to say that the input from commenters is extremely valuable to the TFTE in doing our work, and we appreciate all the time and thought that everyone has put into their comments. And with that, I'd like to turn the floor over to Frank Lebat, Senior Vice President and Global Head of Tax at Sanofi, on behalf of BIAC.
Thank you, Michael. And you know, like other panelists, I want to offer my thanks for having the opportunity to provide some comments and highlight some of our comments earlier on. Just want to echo Arim's opening comments on not confusing the forest for the tree. This is very true. We all know what a forest looks like. The question is it a nice forest like Bois de Boulogne where you want to have a nice stroll on a Monday afternoon? Or do you, and I see John there, or do you end up in a Walt Disney movie with the evil sorceress and it's a forest, you don't want to go there? And you know, to answer that question, unfortunately, you have to look at the trees also and not just the forest as a whole. So I think that's clearly, I think, what we're trying to do, and certainly the BAG and the BIAC are trying to be constructive in our feedback, and we'll definitely continue to do so. So if we can move on to the next slide. We're talking about elimination of double taxation. You know, since the progress report has come out, obviously many groups have done modeling. You know, we've been discussing with quite a few. Many groups will not see an increase in their effective tax rate as a result of Pillar 1 as it looks like. So no increase in the ETR. Some will actually see a drop in the ETR. So, you know, why do they complain? Well, this is true if elimination works. Because if elimination doesn't work, then that will become a financial issue for most groups. So how do we ensure that we get full elimination? And quite honestly, that building block together with MDSH was the one I was most looking for, because that's the one that matters the most for me. Yes, there are difficulties in the nexus rules, how do we build the system, so on and so forth. That's administration. It's not a small matter, but it's administration. Financial impact, it's on the elimination. Now, what matters to the business community is that we have an effective elimination mechanism, which means simple, certain, and timely. Now, when you look at that, there are some concerns. There are some questions that we're having, and whether we will get an effective elimination. I will not get back to the withholding tax discussion. We've heard about that, but it's part of the discussion. We understand the need, and Michael expressed that in his introduction. Formulaic is a way to make simple. That's true. We still have complexity built in the system, but it's an approach, and we certainly could live with something formulaic, but we need some mechanism to correct, I would say, the biggest distortions that we may be seeing in such a mechanism. So I listed on the slide, and I'll run through them fairly quickly, some of the complexities that we're still seeing in the systems. We don't have an harmonization between the determination of the tax base for amount A and the elimination profit. So we have two computations to make. Okay, just two computations, but it's coming on top of all the other complexities in the system. Where we're getting maybe paranoid, but we're worried, is obviously some of the aspects that have not been published yet. We've heard and we understand that obviously we're having a jurisdictional approach for the relieving countries. Now, how do we move to that, to the reality of legal entities in a country? And we fear that an additional layer of complexity is going to be built in that at that moment, which makes sense. I mean, we're starting from consolidated accounts, moving to country vision, down to tax, so different referential, legal entity. And that last step, which is the one we haven't seen yet, will in itself create additional complexity and difficulties. Another element which we've noted is the whole premise of Pillar 1 is moving away from the arm's length principle, and the arm's length principle get reinjected in the definition of elimination profits. So once more, this is the difficulty of moving from console books to tax base that needs to be eliminated. But we're not walking away from those concepts, and we may need to reinject arm's length principle. And all that is layering difficulties and complexities for our systems to manage, as simple as that. The other elements which I mentioned in that slide, won't talk too much about it because I think other panelists will cover that. The timing and method of elimination are key for us, and that's the whole credit versus exemption discussion, obviously with a very strong preference for exemption on our part. And finally, the last point on this slide is important. We have not seen any backstop safety net to ensure full elimination. Now, once more, this whole thing is all very well. Michael explained in his introduction, we're not here to create new taxation, we're here to reallocate taxing rights. Well, somewhere in the rules, we need to have that clearly stated, that in the end, there will not be a double taxation of tax bases for the taxpayer. And there are several ways that this can be addressed. One of the areas where we're worried is what happens if one of the relieving jurisdictions applying the methodology in the model rules is an entity that has not signed the MLC. How do we get actual relief in that case? So all those elements are important from us to make it effective. If we can move on to the next slide, I'll discuss about the waterfall approach. And through the modeling that we've done collectively, we are seeing distortions resulting from the application of the rules. I would say the most common one, or the one I've heard most about, is market-to-market reallocations. So we're seeing, and some panelists alluded to that earlier during the discussion in the first panel, we're seeing market countries being relieving jurisdictions for other market jurisdictions. We're seeing investment hub jurisdictions being relieving markets. So obviously when I'm saying that, everyone thinks, well, that makes sense. That's what the rules are designed to do. Yes, but what we're seeing as well is that in some cases, the investment hub profitability is lower as a result of the reallocation than the market jurisdiction, which does not necessarily make sense because all the investments to generate those consolidated profits are in the investment hub. Why should they have a lower return than the market jurisdictions? And we're seeing as well, reallocation of profits between investment hubs. Here again, that sounds logical. The difficulty we're having is that even for centralized groups with consistent business profits around the globe, which those rules clearly have in mind when you analyze them, well, even for those, we're seeing disconnection between the relieving jurisdictions, which are surrendering tax base to market jurisdictions that they're not serving. And that's really, I think, one of our suggestions. We understand we're trying to keep things simple. We are trying to be high-level, formulaic. But there needs to be, once more, a safety net so that connection with the market jurisdictions that are receiving Amount A is one way or another taken into account to ensure that we can get rid of the biggest distortion that we see when applying the model rules. I'll move on to the next slide, which is really a focus on RODP. Now, going back one step, Amount A is about a return on sales. The elimination is really focused on the return on depreciation and payroll. That's what we've seen, what we heard Michael explain. As was alluded earlier today, RODP, we feel, is not, in all circumstances, a relevant metric. We understand why it has been chosen as a proxy for substance, but it does not account for the differences in business models, in profitability between business lines or business models. Insourcing, outsourcing have an impact. Where you are in the, where the country is in the investment cycle creates differences and difficulties here, and therefore creates distortion in the end. All the other levers that are generating the profits, like the level of capital, those elements are not taken into account in the RODP. So that's one of the difficulties we're seeing here. Now, the statement that RODP is a backward-looking indicator really turns around two elements. It favors tangible assets. So heavy industries with high investment in CapEx get a better comparatively treatment than other groups. And we feel that those industries are more likely to have a high carbon footprint and therefore an environmental impact, which in this day and age, we are just wondering whether that's really what we're trying to promote here. The other impact, and it's true for the industry I work in, biopharma industry, but it's true for other industries, is where you have a very R&D intensive industry, the RODP doesn't take into consideration all the investment that you've made into your IP. There's no way to capture any return to the IP. And as I mentioned earlier on, that means that some of our investment hubs will have a return which will be smaller than our market distribution. Well, we don't think that's correct, and we think that for the jurisdictions that foster innovation, that's depriving them from a share of the return they should be entitled to on the residual profits of the group. Now, RODP in itself will not allow us to fix that, even if we were to move on the return on sales, but it is a combination of all the elements that we heard earlier on and that we will continue to hear on that will allow us to solve some of those distortions. And with that, I will turn it back to you, Michael.
Thanks very much. I think a lot of good input there. Interesting things that I'd like to explore a little bit, but want to give each of our panelists a chance to discuss. So we'll turn the floor next over to Quinn Huynh, Principal with Washington National Tax Practice of KPMG.
Thank you, Michael. If we can move to the next slide. Sort of as by way of headlines in terms of the remarks, I think, we appreciate that the elimination of double tax is probably one of the more difficult aspects of Amount A, like the MDSH, because it largely is technically very complex and also effectively, from a political standpoint, governs essentially which jurisdictions will be surrendering. So, which jurisdictions within the inclusive framework are going to gain from Amount A revenues and which ones may lose out because they will have to cede some profits to a reallocated jurisdiction. And we recognize also that in light of the framework and the negotiation, and as Michael and others had indicated, sort of the timeline by which the inclusive framework has been operating, there is a sense that they're trying to achieve both simplicity and technical accuracy in balancing sort of these objectives. And I think for the perspective of business, the main goal, obviously, or one of the main goals is that the elimination of double tax, as Frank has said, is actually timely and effective and provided in a way that is simplistic enough both for tax administrations and taxpayers to follow. And of course, I think we do believe that it is a goal that the inclusive framework does share. It's stated in the October political agreement that the elimination would be fully relieved. Some of the other issues in terms of headlines, if we can move to the next slide, deal with the legal certainty and the legal convention. It might have been a simple assumption before the public consultation document came out that, for example, where you had three principal entities within a group all earning a similar return, that the elimination of profit would have been taken from each of these three principal entities. You just reduced 25%. That's very simplistic in light of what we do know in the public consultation, which is that the proposal, as Michael had indicated, is formulaic or it's quantitative and it's jurisdictional. It's trying to find or identify the jurisdictions that have the highest return on substance, and in this case, the substance being measured by a return on depreciation and payroll. Furthermore, the rules take an approach where there's tiering so that once you've identified the jurisdictions, you're tiering and trying to narrow it down to where there's the highest concentration of elimination profit among a small subset potentially of jurisdictions that fall within the 4 different tiers. And just clearly from a political perspective, this is an approach that potentially is one size fits all, and it can lead to outcomes that result in a particular principal jurisdiction being the one that is relieving most of the tax in the allocation process. And so you could have jurisdictions, for example, that are ceding profit, as Frank indicated, to other market jurisdictions, and doing it in a way where there isn't a connection between the profits that are being ceded and the market jurisdiction that is being allocated the Amount A income. So, for example, if you have an M&E with global operations that are frequently operating in 2 or 3 different regions with principal entities there, the residual profits based on this return on depreciation and payroll method may reallocate again, not on the basis of where you would think the principal operating and selling into a particular market would be the ones relieving. It's disconnected potentially from that. There are also situations where an M&E that earns a particularly high profit or a high return in a particular jurisdiction because there are products that sell particularly well, they can earn a premium there, that the measurement of, again, the return on depreciation and payroll don't effectively address or account for in the elimination or the identification of the specific jurisdictions. Also, the effect of the tiering itself can also lead to strange or distortive outcomes, because you could have jurisdictions that are in tier 1 or 2 fully relieving the Amount A, and so you don't get to the lower tier 3A or 3B, where you might have more of a connection between, again, the profits that are being ceded and the actual market itself. But the point of this slide is really that we appreciate and understand that the inclusive framework is clearly trying to balance a lot of different objectives in coming up with a Pillar 1 solution that would stabilize the system. And one of the things that we wanted to remark or underscore is that whatever the solution, taking into account that I'm sure that a lot of these issues and the potential distortions will be thought through, whatever the outcome is, I think it does need to be reflected very clearly in a multilateral convention. In international tax agreements, oftentimes the elimination provisions are drafted sort of high-level, blunt. because they're necessarily incorporating sort of the domestic law mechanisms. But I think in the context of this particular work, notwithstanding a lot of the criticism about having too much detail, at least with respect to the elimination process, might be something that should be incorporated into a multilateral convention to ensure that countries are following through in terms of their commitments and that their domestic law is not prohibiting or inhibiting them from fully and effectively providing the relief in this case. One of the other items that I wanted to mention in terms of the transparency of the process and the fact that the public consultation document was a lot more comprehensive and did provide a lot of the sort of ingredients, if you will, in terms of how the elimination might work. But there is still a little bit of, it's a complicated document, and it's hard to fully appreciate all of the interactions between the MDSH, for example, and the elimination rule. Furthermore, I think the X factor or the X multiplier that's indicated kind of leaves open the possibility that the elimination rules are not clearly sort of understood. And I don't know if the X factor, which is sort of if there is an adjustment to the MDSH to account for an amount A reduction, then you would have a potential offset or this X factor that would reduce or eliminate some of the profits in the same market jurisdiction. It has been indicated that the X factor or the multiplier itself could be a way in which the inclusive framework, as a part of the negotiation, tries to introduce or incorporate some element of a domestic business exception. And I think I just wanted to dispel that. I think while helpful, and obviously the multiplier that may or may not be used is not defined or stated. It's something that is continuing to be under discussion. But if it is retained, I wanted to just underscore that I don't think it is actually an exception or a replacement for a domestic business exception, because under the domestic business exception, the profits that would have been isolated within a particular jurisdiction would have been removed from the amount A system altogether, and just sort of embedding an X factor as a part of the elimination doesn't quite address or effectively do the same thing that the domestic business exception would. On the next slide, I wanted to just highlight some of the other issues, which I think the document sort of also indicates and highlights that, what we are trying to do, or what the inclusive framework is trying to do, is layer, again, on top of an existing system, some of the changes. And with that comes a bit of difficulty. There are a number of other issues and questions about how the existing tax system gets incorporated with respect to the things that are being discussed as a part of the elimination. So on this slide, I think I just had questions that aren't really answered in the public consultation document relating to, what entities or entities within the group are going to be legally liable for the tax arising from amount A. Clearly, that is something that is important at the end of the day to businesses. Obviously, the fact that a jurisdiction might be a relieving jurisdiction is just one element. At the same time, the entities that pay tax in the market jurisdiction, are they going to be able to receive and effectively get benefits from the relief from double tax? If you have an entity within the covered group that has a minority shareholder, is there anything that will be done or considered to protect the minority shareholder from the application or the results of the new amount A system? And then for jurisdictions that do or don't have a consolidated tax regime, will there be differences in terms of how these mechanisms will apply, or whether they need to be moderated to account for the fact that there may be different taxpayers either on a consolidated or single entity basis? And then also very important as well is just as entities enter and leave the group in the context of the existing system and the elimination system to be developed, how are governments thinking about tracking and taking stock of whether elimination in those contexts would be fully relieved? And as Frank said on the next slide, I think one of the more important elements that has been indicated in a lot of different comment letters is the method by which double tax is ultimately relieved. The travel of direction in the public consultation certainly leads to the conclusion that it's going to be left to either an exemption or a credit mechanism or whatever the other alternative would be that countries apply today. And so I think the comment here is that overwhelmingly a lot of the responses to this question were that an exemption system in the context of Amount A would be much simpler, much more effective. When you're trying to deal with a credit system and accounting for Amount A, one of the difficulties will be just how do you allocate the foreign tax among the different market jurisdictions to a particular legal entity within the ceding jurisdiction or surrendering jurisdiction, because it'll matter if the tax rates are different in certain markets with respect to their Amount A profits, how much you are ceding and how much you're able to credit. If you're applying it on top of existing credit mechanisms where tax attributes of particular entities matter, could effectively impact whether or not relief is going to be effective and timely, as Frank was saying, that one of the things that businesses do want to guarantee is that the complexity of Amount A overall needs to be relieved through a simple system. And I think to Michael's question earlier, if you're thinking about simplification in the inclusive framework, a move towards exemption of the Amount A would be one way you could effectively deal and respond to some of the comments from business. Some of the other issues that I wanted to highlight sort of repeat and sort of pick up from Frank's questions, which is that there isn't a clear backstop provision included within the document. So for example, if you have companies that have a lot of losses as they're starting to develop, and they may not have enough, because the Amount A system and computation is based on financial tax accounting, as you know, with a lot of adjustments. If you're putting elimination into a particular surrendering jurisdiction and there isn't enough actual tax profit in that jurisdiction because they could have had losses and other things that aren't accounted for, it may not be a jurisdiction that can effectively and timely relieve the double taxation. And dealing with carry forwards, unless you can do a carry back, again, just adds further complexity to the system. And so I think we would stress other alternatives being considered for a backstop. Somebody for a backstop. And then I think lastly, I will just note that one of the things that would also be very helpful in terms of the document as you're doing another version, hopefully, is more examples illustrating the application of these rules, and examples that cut across different business operating models as to how the rules should be interpreted and applied, because again, I think that will add to the tax certainty and increase the level of effectiveness of these rules. And with that, I'll turn it back to Michael.
Thanks very much, Quinn. Certainly a number of important issues still to come. I'd like to turn now the floor to Guy France, the Vice President and Head of European Tax for Sony, representing Keidanren.
Thank you for the opportunity to speak today. As Michael said, I'm representing the views of the Keidanren, which is the Japanese Business Federation, in addition to those of Sony. As recognised in the progress report, there are two aspects to giving double tax relief. The allocation, firstly, the allocation of the Amount A double taxation elimination obligation to the relieving jurisdictions. And secondly, the mechanism for the relieving jurisdictions to provide the relief. And I'm going to focus on the second of these points. So some of the key considerations regarding the mechanism for achieving the double tax elimination were considered in the Pillar 1 blueprint. The intention was clearly expressed that the paying entity is not subject to tax twice on the profit in different jurisdictions, once under the existing profit allocation rules and once under Amount A. And, you know, the progress report doesn't move things forward in that regard, the focus of the work on double taxation having principally been on the allocations. Nonetheless, from our perspective, the mechanics of the elimination of double taxation is an absolutely critical point to the fairness of Pillar 1. And we are strongly concerned to ensure business receives double taxation relief in an effective manner, we believe the exemption method is the best way to achieve this. The blueprint considered that the obligation to pay tax in a market jurisdiction would fall on residual profit entities located elsewhere, and as a result, the potential double taxation would be on a single entity in multiple jurisdictions, i.e. juridical double taxation. And in that case, the blueprint determined that either exemption or credit methods of removing the double taxation would be appropriate. However, the identification of the relieving jurisdictions in the progress report is significantly different from the blueprint in that the allocation is done on a purely formulaic basis without regard to where the residual profit from any transaction is actually taxed. And so also leaves open for now whether the taxpayer is to be the relieving entity or a different local entity. In other words, relief may be granted from taxes paid by different entities in relation to unrelated sources of income. This is not juridical double taxation, but rather economic double taxation, which the blueprint recognises is best relieved by the exemption method. Applying a credit method in this case will lead to significant additional complexity for the reasons just covered by my colleagues, and we therefore strongly recommend countries choose an exemption approach, even if the final Pillar 1 document permits both exemption and credit methods. However, where ultimately relief is given by credit nonetheless, the following changes to existing credit systems must be adopted. Credits should be permitted against any tax paid regardless of the source of income. As identified in the blueprint, domestic foreign tax credit regimes tend to have sourcing rules that can result in part of the income that was taxed in the source country being regarded as domestically sourced income in the country of residence and therefore not eligible for tax credit offset. The formulaic approach to allocation of the relief of amount A will often result in no connection between the relieving jurisdictions and the market jurisdictions, and thus the refund of taxes may come from taxes paid on business divisions or from other business divisions or purely local business activity. This should not result in a restriction on providing credit relief. The foreign tax credit method often has limitations, including restrictions on carrybacks to prior years, amounts claimed in any single year, and restricting carry-forward periods. If the system is designed based on these restrictions in each country, it's highly likely that relief of double taxation could be delayed or even denied, contrary to the principles of the blueprint. The very carry-forward of credits is in itself inequitable in the context of Pillar 1. As Pillar 1 is proposed as a mere reallocation of taxing rights, the elimination of double taxation should be available immediately, in cash, in the year where Pillar 1 tax is allocated to another jurisdiction, not subject to being carried forward where inflation and potential forex fluctuations can reduce the value of the credits and result in negative cash flow impacts to the company. If a credit system is implemented, therefore, it must be established through a multilateral convention in a uniform manner that addresses these concerns and provides immediate utilization or refund mechanisms. Pillar 1 provides new and novel taxing rights that require unique rules for the elimination of double taxation, notwithstanding countries may have other tax credit regimes in their domestic law. The risk of double taxation and administrative burdens would be lessened if a uniform system is adopted. Other concerns about elimination methods are the following. There continue to be unclear issues, such as who will be the filing and paying entity, how that is coordinated with the relieving entities, and how withholding taxes are treated. Secondly, there seems to be scope for simplification by better aligning the definition of Pillar 1 elimination profit with that of Pillar 2 globe income. Thirdly, the method of eliminating double taxation in cases where the relieving jurisdiction already has a permanent establishment that is taxed in a market jurisdiction should be clarified. And finally, the timing of the elimination of double taxation, in particular where there may be different year ends, and the method of calculation in the event of corrections needs to be explained. Overall, in considering the complexity of creating a new tax credit system just for Pillar 1, we continue to strongly support an exemption system rather than a credit mechanism to provide effective relief from double taxation. Further, although not the topic of this session, let me make a few comments on revenue sourcing rules. We welcome the removal of the transaction-by-transaction approach and the expanded use of pro rata calculations based on the allocation keys. However, some items remain difficult to implement, such as sourcing sales through independent distributors, components, and the provision of services to large customers. We believe that additional examples in the commentary will be very helpful. And as for reasonable steps for the use of the allocation key, we welcome the clarification that changes to contractual agreements are not required, and we would like to see detailed information on what constitutes reasonable steps clarified. If such examples and clarifications are provided only in the commentary, then the commentary must be incorporated by reference in the multilateral convention to be legally effective and uniformly applied. And finally, we also believe that the advanced ruling process and transitional relief while that process is ongoing is necessary to give time to implement this brand new and novel taxation framework in an effective and efficient manner. Thank you very much.
Thanks very much. A number of important issues you've identified that we will need to take into account in future work. I also should have mentioned at the beginning, there is a 100% chance that I have mispronounced or will mispronounce panelist names, and I am sincerely sorry about that. That's a hazard of being out of the room here. So with that, I would like to turn the floor over to Vijay Pandya, Tata Consultancy Services.
Thanks, Michael, and thanks OECD for providing this opportunity to discuss on this progress report on Pillar 1, an essential building block, which is the elimination of double tax. So if you look at it from a business perspective, whatever has been given in a progress report, amount to be allocated to market jurisdiction and pay the additional tax, so long as the tax which is doubly needs to be paid by the business is eliminated. As far as the business is concerned, there is no additional cash flow or no additional P&L impact. Then business should be neutral the way in which rules are drafted. So those aspects of making sure that elimination rules are drafted properly to make sure that there are no double taxation is one of the foremost things which rules should address it. Let me discuss that. Generally, when you have international taxation, there are two approaches which are followed. One is the separate entity approach or a global approach. And as far as the bilateral treaties are concerned, by and large, based on OECD and others models, the separate entity approach is followed. Whereas in this case of a pillar one and pillar two, some sort of integrated approach which has been played out. And that is why there are lots of open point or some various discussion which we are having how to address such challenges when you follow the kind of a combined approach. For some part of it, you follow the group approach and separate entity approach. So let me see that if there are double taxation of an M&E group, it is always a cost for the company. So this rule should be able to address those kind of a double taxation. And this can be addressed by way of a domestic rules, which is there in a current progress report, which requires that how the domestic rule should be there to address. At the same time, multilateral convention should also address this very explicitly. If you look at it, the country, the way in which they give a priority to the domestic rule or the treaty, it varies. So like in India, whichever is beneficial, like a domestic rules or a treaty, should be given a priority. Certain countries gives a priority to later in time prevail. Some will provide treaty as overriding effect. So to avoid all this confusion from a taxpayer point of view or M&E group point of view, so long as multilateral convention clearly defines elimination of tax and certainty in respect of that, that is what business will look for it. Now, if you look at it, Title File 5, which is addressing this elimination of tax, there are complex rule. Everybody has said, but complexity is required considering the issue under hand. But at the same time, there are clarity which is required, and the rationale of particular things needs to be explained so that from a implementation point of view, from a tax administrator or from a taxpayer point of view, they should understand what is the rationale for why they are applying particular rules. Now, if you look at it in this aspect of elimination double tax, the first point is to determine the tax base determination, correct? So the way in which tax base determination works is that first you have to start with the profit and loss of M&E group, and then you have to make certain book to tax adjustment. So these kind of adjustments are required in pillar one, pillar two. But certain components are different. The adjustment which are proposed book to tax are different in pillar one and pillar two. Within pillar one also, we understand one first point is required. You have to arrive at the adjusted tax base of a group, as well as you have to arrive elimination tax profit of a group entity. There also certain adjustments are different. For example, if I have to call out like stock-based compensation and accrued pension cost related adjustments are given while computing entity level adjusted tax base, whereas while computing group, these adjustments are not mentioned in the progress report. Though both are different, like once you are determining group tax base, one is entity, but as far as possible, things should be aligned and explanation can be provided why particular adjustment is not considered in particular requirement. Now, second point is that application of this elimination double tax amongst the relieving jurisdiction. So, as everybody mentioned, it's a waterfall approach, stepped approach, tier approach, whatever we call, but which takes into RODP as a primary factor to determine how which entity will be the relieving entity and to what extent. But the fact that certain entity may have an intangible or they may have a capital employed kind of investment company. As of now, there are no return provided to such kind of activity or such kind of entity. So to some extent, if you look at it, pillar A, they at outset they say 10% is the routine return and then balance is the excess or super normal profit. So in such scenario, while giving this determining the relieving entity, can there be some threshold of a percentage of revenue, and after that only elimination profit can be relieved? That kind of a provision, if it is there, to some extent that addresses the intangible or capital employed related aspect of a particular entity within the M&E. Again, it's a hybrid approach. There are different percentage of RODPs mentioned to go step by step to to what extent the relieving happen from the relieving entity. So basically this 1500%, then directly jumping to 150% and 40%. So is there some rationale or some basis to arrive different percentage? Obviously there may be some economic rationale based on the data which is available with OECD, but something if high level can be given to business to understand, so that business can also appreciate what is the approach and what is the rationale behind this applying this. So that, and alternatively, I understand RODP is one of the factor based on the substance has been considered by the OECD. But then since the way in which amount A is allocated based on the revenue sourcing, is it a possibility to determine the living entity based on the allocation of pro rata of excess profit also? That can be one of alternative that may not achieve a desired result, but can be thought through as an alternative to RODP if there are large concern relating to RODP as a factor. And obviously, once all this exercise will give us a jurisdictional level, what will be the elimination of a profit and how much tax to be eliminated. But again, within the jurisdictions, some M&E operates into large number of entity. So out of that total jurisdictions elimination, which entity should account for which, that will be very more important from a finance and account point of view. So that rules also should address, so that at least there are no dispute within the jurisdictions how much to be allocated. As far as the method, everybody spoke about the exemption method will be the preferred method as far as the relieving the amount A excess tax in the market jurisdiction. So rationale is that, see, objective of pillar 1 is that wherever market is there, they should get the tax. So at the same time, that is achieved by allocating this profit to the market jurisdiction, and whatever rate applicable into market jurisdiction, be it a higher or a lower compared to the relieving jurisdiction, the M&E should pay the tax in that jurisdiction, so that whatever profits are taxed, that should be eliminated from the tax base of a relieving entity and added to the market jurisdiction. So that will achieve a simplicity, because credit method per se has a lots of complication, because it requires us to identify one-to-one mapping of relieving entity and market jurisdictions. There may be at a time, there will be more than one relieving entity, more than one marketing entity. There may be a different tax rate in both the countries. So how to map that, how to relieve the tax, those kind of rule will be further complicated, similar to RODP waterfall approach. So there will be more debate required, rather than going into that if exemption method is proposed, that will be achieve a simplicity and objective of pillar 1, which is to pay tax in market jurisdiction. So these are the things, and obviously, as earlier panel also mentioned, this is by and large economic double taxation, which can be very well addressed through exemption method. Whereas if there are jurisdictional double taxation, obviously one can look at it credit method, but in case of economic taxation, economic double taxation, exemption method is best suited in the given circumstances. As far as withholding tax, again, one point about market jurisdictions, whether it gives a double tax to the market jurisdiction, that is up to some extent it is right and some extent wrong. So there has to be some mechanism, either fully or partly relieve from that double taxation if withholding is happening in the market jurisdiction, because M&E is going to pay tax in market jurisdiction under amount A. At the same time, will going to suffer withholding. So that situation should be addressed appropriately. Yeah, thank you.
Thanks very much. Number again of important issues there, including future work. We want to turn the floor over now to Rick Miner, Vice President and International Tax Counsel at USCIB.
Thanks, Michael. I'd like to thank the task force for the opportunity to participate on this panel. I'm here today as head of tax for the U.S. Council for International Business. USCIB is a multi-industry association of U.S. multinational companies and advisory firms. More detail on the USCIB Tax Committee can be found in the appendix of this PowerPoint. Last month, we submitted a consultation letter in response to the progress report. The positions in that letter still stand, but my comments today are informed by the fact that a key number of our company members have performed modeling exercises under the quantitative formulas in the progress report. My hope is that there will be engagement going forward between the business community and the task force to reconsider the design proposals and or to reconcile the distortions that these modeling exercises are revealing. The purpose of the Pillar 1 project is to stabilize the international tax system, and we support that purpose. We support a Pillar 1 that can efficiently reallocate certain profits to market jurisdictions, but is designed to do so without opening the door to government opportunities to impose, in addition to the Amount A reallocation, incremental tax burdens, leading to more double taxation scenarios, ostensibly in the interest of achieving fair taxation. Pillar 1 design has to be airtight in this respect. We're also concerned about the pace of the design process. I wish to repeat here that we anticipate the opportunity, without unreasonable time pressure, to review the complete set of Pillar 1 design rules once the rolling consultation period is completed. It would also be nice to see an MLC framework this fall. Go to the next slide, please. We are all aware of the challenge of layering two very different global taxation systems. I'm referring here to Amount A and the arm's length standard. This is all the more reason that we take the time needed to iron out the distortion-creating features of Amount A design. I wish to highlight the comments in our consultation letter on the elimination of double taxation. The first part concerns Title V design issues, and the second part are other risks to double taxation. There are two tests under which next slide, please. There are two tests under which a specified jurisdiction can arise for a covered group's Amount A calculation. First, there is the minimum number of jurisdictions that constitute 95% of the elimination profit of the group. The second test adds to the elimination formula list jurisdictions not included under the quantitative measure of the first test, but which have an elimination tax base equal to or greater than euro 50 million. We propose that the second test for specified jurisdiction status be struck in the interest of simplicity. Regarding timing, we propose that subsequent Amount A adjustments and tax liabilities for prior years be telescoped so that the adjustments are made in the group's current year tax return. USCIB members support the use of full and modified telescoping. Full telescoping is already used in many MAP and APA procedures, and this experience at taxpayer and tax administration level would be an advantage here. Under the current elimination rules design, there is no market connection condition for the relieving and allocation jurisdictions with respect to a covered group. There's a risk that this disconnect could destabilize the Amount A system if tax administrations are unwilling to accept it. A comprehensive MLC and robust tax certainty process could be the solution to eliminating this and other loose ends mentioned on this panel. The progress report leaves open the method for eliminating double taxation on the elimination profits in the relieving jurisdiction. Double taxation might be sought to be eliminated through the exemption method or the credit method, and there is potentially a third method for jurisdictions which under their national tax laws use neither the credit nor exemption method for double tax relief. The exemption method should be the only method used in the relieving jurisdiction to eliminate double taxation on reallocated profits. The exemption method is the most common method of double taxation relief internationally. There's significant corporate taxpayer and tax authority experience with the exemption method, and that seems to be an obvious advantage. There need not be any special set of rules or exception for jurisdictions that have traditionally used methods other than the credit or exemption to relieve double taxation. USCIB did not comment on the formulaic calculations in Article 9 in our consultation letter. Since our letter was filed, some of our members representing a decent range of business models have modeled the Article 9 rules and can demonstrate that unintended, if not unacceptable, distortions result from the design approach in Article 9. As at the outset, we note the situation and encourage further direct engagement between the business community and the task force to consider the implications for crafting the airtight design of these rules. We would also like to point out there is a mismatch in the approach used to calculate Amount A, simple profits on sales over a deemed 10% 10% return, and the return on depreciation and payroll formula for allocating eliminated profits to the so-called market jurisdictions. The proposed design seems to the business community to have, in effect, complicated the simple reallocation principle on which Pillar 1 was based, and has done so in the interest of political goals that have not been fully articulated. We reiterate our concerns in using the proposed approach in light of the planned significant increase in Pillar 1 scope through the decrease in the sales threshold to euro 10 billion several years after the initial effective date. Next slide, please. Next, there are some double taxation risks worth mentioning beyond the design of Title V. Withholding taxes levied by market jurisdictions on outbound payments must be accounted for in the elimination tax calculation. Withholding taxes on Amount A income should be included in the calculation for double taxation relief. Almost all of us seem to agree on this point. Otherwise, we have a genuine fear that market jurisdictions will use these taxes as a lever to collect incremental tax revenue from covered groups in a way that is inconsistent with the principles of Pillar 1 and causes a new set of real double taxation issues. The modeling insights, which were described in the first panel, suggest that the proposed MDSH cannot adequately avoid double taxation on residual profits of covered groups. Finally, we cannot overemphasize the importance to the business community of the Amount B feature of Pillar 1. As a matter of principle, there can be no overlap or double counting between Amount A and Amount B calculations that would lead to final double taxation. This would be fundamentally at odds with the goals of Pillar 1 as established in the blueprint and with international tax principles in general. We have referenced in other consultation letters one or two credible third-party studies on designing a robust Amount B feature. We encourage the task force to consider these studies. A practical design for Amount B and a coherent relationship between Amount A and Amount B are essential to achieving the greatest administrative simplicity among the design options. Amount B, after all, is not limited to in-scope Amount A groups and will be broad in its impact and its benefit. As I come to the end of my presentation, I'm mindful of the enormous efforts the task force has invested in the process. Our comments are not unique to USCIB members, but are largely shared by other businesses that are concerned about the design proposals for Pillar 1. We look forward to the time when we can comment on the comprehensive set of the Pillar 1 draft rules and are prepared to support the task force directly and through the BAC-BAG process on these key issues. We respectfully urge the task force to allow for a significant amount of time for any comprehensive review of the Pillar 1 rules. We are in general alignment with our Treasury Department that Pillar 1 should stabilize the international tax system, but do no more to burden international commerce by creating new opportunities for jurisdictions with new taxes or self-serving interpretations of existing taxes. If the ultimate Pillar 1 design is not airtight as concerns the prevention of double taxation of Amount A, the efficient and successful maintenance of it on a global basis will not be possible. We will continue to engage constructively with the task force with this ambition to prevent double taxation in mind. Thank you again for this invitation. Michael?
Thanks, Rick. Really appreciate that. This panel has been very substantive, as indicated by the number of questions that we've received about this. So on the first question, want to circle back on a point that Frank raised and that has been raised in a number of comments and that I talked about in my introduction as well. And this is the assertion that the elimination mechanism based on RODP will favor certain industries over others or certain groups over others. And the question is, how will it favor certain industries or groups over others? It doesn't reduce the amount of elimination provided to a group, and it compares the group to itself. It takes 10% of sales and calculates what RODP that represents. So just wondered, Frank, if you could provide more detail on what you mean by that calculation or that mechanism favoring certain groups over others.
And certainly, I'll try to, and obviously my friends in the panels can jump in as well. When you point out that the mechanism compares the groups to itself, it compares a country situation to a consolidated vision of the group. And that is highly different. That is highly different because you have country situations, you're not in the same level on your cycle, whether it's in R&D, whether it's in CapEx investment in a given country compared to your group situation. And that in itself can just create distortions. Additionally, the objective of the MDSH is to ensure that we eliminate double counting, double taxation, right? So if your underlying tool to achieve that objective does not account for the full elements that generate your consolidated profits on which you based amount A, just there you have a loophole. Now, depending on the group situation, and once more, where they are in their investment cycle and their activity or their strategies of outsourcing some elements in some countries versus insourcing in other countries, then you create those distortions. So it's not sufficient to say you compare yourself to yourself, because once more, the granularity upon which you're building your comparisons is different, and that in itself creates distortions. I don't know if some of my fellow panelists have additional comments.
Thanks. That's helpful. I don't know if there are further comments on that, but I have a related question. I think every panelist discussed the creation of distortions. I think it would be helpful, and I know we don't have a lot of time, if panelists could say more about the baseline against which they're comparing to identify distortions. So in other words, how do you know that there are distortions? What's the baseline that you compare against in order to know whether there is a distortion?
I guess I'll start and I'll let others to come in. Well, certainly we know our groups. We know where the residual profit is falling. We know our transfer pricing policy. We know our value chain. So when you have an investment hub that ends up being a relevant jurisdiction for a market it's not serving, it has not invested in, you see here a distortion. And there are many other elements. Some of the other M&Es that may have made modeling, see market-to-market jurisdictions, see that where you have entrepreneurs in your own market serving just their own market, and those countries are supposed to surrender profits to other countries with which there's absolutely no connection. We view that as a disconnect. So it may not be a disconnect if you think I'm going full formulaic and the outcome of the formulaic is by definition non-disconnected. Yes, in that case you're right, there's no distortion. But when you compare to, once more, the reality, the value chain, the activity carried on the ground, that's where you see those distortions. Once more, I'll shut up there and let other panelists come in.
I think I'll just reiterate what Frank has said. I mean, some of the distortions, as you said, even though you are comparing the average of the group within the group itself, depending on how the group is operating within particular jurisdictions, if there are lots of tangible assets and payroll or headcount in one particular jurisdiction to another, I think the over-reliance on the return on depreciation and payroll itself can create distortions as to which of the jurisdictions end up being a specific jurisdiction that has to surrender or not. And as Frank says, a lot of the way in which the approach is heading is that the outcomes may lead to investment hubs, or so-called investment hubs, being the jurisdictions where you might take relief from first, and that may or may not be indicative of where the residual profits really are with respect to a particular market. And so there is a disconnect from that perspective of the underlying profits that are being used to relieve or surrender not being truly the types of profits that are allocated or have a connection to a particular market jurisdiction.
And if I may jump back 1 second, fully agree with the comment. I think it's something that I wanted to mention earlier on, which I did not. Some M&Es will like the purely formulaic approach because of their business lines because they are huge conglomerates and which, for which it would be far too difficult to try and get back to a nexus approach. But I think many groups consider once more that to avoid those distortions we're talking about, having some kind of market connection, backstop, link at some point will be very important.
Great, thanks. And just to be clear, I think the intent is to understand how you measure distortions so that we know what possible alternatives are. It looks like we are over time, so I think I need to hand back to Akam and want to thank the panelists. I think this has been a great discussion. Really appreciate all the thoughtful input.
Thank you to the panel. Thank you to Michael. We will now switch, I think. We'll go to the next panel. So this time I'm the moderator, so I can't invite anybody to be the moderator, but if we could have the panel members come up and take their seats. And again, thanks to all the members on this panel. And yes, you can and you should. Michael, they're clapping just in case you're not seeing this. As they take their seats, I start talking. We do receive some questions. If we're not able to answer the question, we had some questions. We ran out of time on this panel. We'll try to answer the questions to the people that asked the questions separately. I can see Megan is with us here. Hello, Megan. So far, it's a very smooth panel. So let me start here to give a brief introduction, perhaps to explain the panel and first the panelists here. Many of those, I think, don't need any introduction. We have John Stoll, who is VP Tax Incentives, International Financial Reporting from the Walt Disney Company. There's Tom Hutchison is Vice President of Alphabet, who is also here speaking, representing on behalf of the Silicon Valley Tax Directors Group that made a submission. We have Janine Juggins, that everybody knows, I think, from Unilever, who's also been working extremely hard as one of the co-chairs of the Business Advisory Group in the Pillar, so thanks a lot for putting in all this time. We have Megan Fankhauser, who is a Senior Director of Policy, Trade, Tax and Trade Information Technology Industry Council. And then finally, we have Ann Gordon, who is the Vice President, International Tax Policy at the NFTC. So maybe I was just going to say a little word because we're now on what you could call a slightly eclectic panel of a combination of issues. The reason is the following. We clearly recognize, look at the comments, that there was a cluster of sort of a structural question where everybody came in on the marketing and distribution safe harbor, linked to that and maybe as part of that withholding taxes, and then also elimination. And if you think about the design of those, you almost have to sort of design them together. So not necessarily that they are the same, but they're integrated and they talk to each other. And so we wanted to draw out a panel on MDSH and withholding taxes to show you the range of views that we've heard, and also for all of you to be present that while we sometimes believe there's clearly one view, there's other people believe there's clearly a different view. And I think we also wanted to bring that out. So for all of those that are listening, that are sitting here, you really see the diversity of views. And then to get some sympathy for the Secretariat that's meant to bring all of this together. So this is all self-serving. Similarly, I guess, on elimination and the implications, I think we've heard on those. And I think that's something that cuts across whatever the business is that you're representing. Then I think when we come to this last panel, it was a bit pick and choose. So first of all, if your issue that you care about is not on this panel, it does not mean that we're ignoring the issue. We just had to choose, if you wish, some selected issues, and I give you a bit of a flavoring why we picked on those. And it does not mean that we're not looking at the others. Some of the other issues we will be dealing with, they may be specific to your industry, so we look at that. and there are some others that we couldn't bring because maybe we feel we already have an answer, so we don't need to highlight the issue. I mean, this is also, again, self-serving, because here are some of the issues that we're bringing on which we're really needing some input, as opposed to some of the others where maybe, you know, the technical teams already have a sense. So with this, I think we will start with John, who will bring us, I guess, magical forests and talking trees potentially, and maybe just to give you a sense before you come in, John, a second, just to frame the issue. So I think the way that we frame the issue, I think you will be speaking about the domestic business exemption, but not in a narrow context. But I think the theme that's running through this is, how can we achieve a level of simplicity within the framework that we have set out, but that limits the instances when we feel that there is results that we have difficult to articulate, bringing it back to the notion of stabilizing the system. And so I think that's a topic, we've seen this topic, and I think you will pick this up again. I think, Tom, you will talk about revenue sourcing. And again, on the revenue sourcing, just to say, we had a first paper that we thought was a significant improvement from the paper that you hadn't seen, that we had discussed with delegates, and they told us, well, you should have shown us the first paper because still it doesn't look very good. I think we've moved it. If we need to move it further, we will move it further, so we create the right balance. But at the same time, on revenue sourcing, you also need to understand that there is a policy imperative that says this is meant to identify the market jurisdiction understood as the end customer. So that is, and it's a fundamental rule, the revenue sourcing rule, not like as we know it for foreign tax credits, it's the principle of allocation, it's where the money goes. So it's a pretty key foundational rule, all of this. And so I think Tom will speak to this. Janine, just a brief word. I think you have always kept us honest. I think that's the function also that you do. So I think you bring a collection of issues that are very important and that you can bring. I think earlier, I guess already, thanks to you, that sometimes you remind us that we had profit components in the allocation that weren't in the tax base. And so, you know, Janine just points out some of the problems in the actual architecture. And then finally, I think we have Megan and Anne speaking both on unilateral measures, and I think that's also responding to what we've heard from many of you. For this to move forward, you need to see the components that come, you need to see the components that go, and you need to see how what's coming is being administered and practically implemented. And you know, that's sort of a forward-looking component that we don't have here. So we felt it's extremely important that while there was not a lot of it in unilateral measures in the text, that we give another space to that discussion in the panel, which is why we have two speakers on that. And now, John, I am not holding you back anymore.
Oh, no, thank you. Thanks very much, Arkham, and thanks for the opportunity to speak at today's public consultation. As noted in the BAC submission and in several other submissions, and frankly in earlier panels today, there have been a number of concerns raised with respect to the scope of Amount A due to the absence of a rule that first excludes the income of wholly domestic businesses as originally contemplated in the Pillar 1 blueprint. I've been invited to provide some more context on this point. This concept, which I will refer to as the autonomous domestic business exclusion, relates to whether the apportionment base for reallocation under Amount A should first be adjusted to exclude profits or losses of significant wholly domestic businesses in order to prevent extreme and illogical outcomes. Doing so would mean the apportionment formula for Amount A would look to a more pure allocation of the profits associated with globally integrated businesses within the enterprise. However, as it's clear, this need for this type of measure needs to be balanced with the need for simplicity. Before we get into some of the specifics, I think it's first important to note a couple of key points. First, the existence of a domestic business exclusion is expected to have minimal, if any, impact for most in-scope groups and for overall tax revenues collected by most countries under Amount A. There are a number of reasons for this, including the fact that a vast majority of the operations of these in-scope companies are globally integrated. or alternatively, the profitability of any large autonomous lines of businesses tend to be substantially similar to the overall profitability of the enterprise. However, for a small number of in-scope groups, the application of Amount A without a domestic business exclusion is expected to generate some acutely distorted incomes that will prove difficult to justify. For this reason, and in the interest of tax simplicity, most groups that have submitted comments have recommended that this be an elective provision. These more extreme distortive outcomes can arise in a number of situations. For example, when a business has minimal or no intergroup cross-border transactions and the profitability of local operations varies considerably from that of the overall enterprise. This can include situations where the domestic business operates in a largely closed-loop system and has significantly higher or significantly lower margins than the overall group. This may be due to a number of factors that are unique to the local cost structure, such as labor or locally sourced raw materials, and where the profitability of operations in one country is not in any way dependent on the profitability of operations in any other countries. Or another example where you may see a highly distortive outcome arising is, for example, with a conglomerate that has distinctly different and financially significant lines of business. For example, where there are significant businesses involving wholesale, B2B versus retail or B2C operations, or say manufacturing versus licensing lines of business with very different margins, which can lead to a reallocation of a tax base that will be very difficult to justify based on the underlying economics of the business. This also highlights the fact that a distorted and illogical outcome can still apply within a very broadly defined unitary tax group. These distorted outcomes cannot necessarily be solved through segmentation, as in most cases, the local country operations are not separately reported as a separate segment, although there may be some supplemental financial statement disclosures that could be relevant. So what's the main reason for not going down this path of an autonomous domestic business exclusion? It's mainly based on tax simplification, which I think is a very laudable goal. This project has an ambitious effort to design a framework that solves the objective goals of improving tax administration and efficiency and tax certainty with respect to cross-border trade, while also solving the more subjective and more political goal of tax fairness. We acknowledge that the design of these types of carve-outs can be challenging. However, as we've seen in other areas of this project, the use of objective thresholds and safe harbors can be used to determine scope. For example, an autonomous business exclusion could only apply where certain nominal and relative thresholds have been met to ensure that it focuses on eliminating the most extreme outcomes. It is not contemplated that this exclusion would apply where there is a meaningful level of cross-border intercompany charges, as that could be indicative of a globally integrated operation. Those supporting an autonomous domestic business exclusion primarily cite the need for this approach to prevent extreme and illogical outcomes and thus see the inclusion of this feature, this design feature, as essential. They appear to accept the notion of using a formulary-based apportionment for apportioning profits to achieve tax certainty and to deliver on the agreement around fairness, but seek to ensure that it is applied on a more appropriate base to produce an accurate and more reliable outcome. By definition, a formulary-based method for apportioning profits is not perfect. Some contend that this is particularly the case where it's only based on a single apportionment factor, such as sales. However, businesses, governments, and other stakeholders need to accept that this is a necessary trade-off to allocate more income to market jurisdictions in order to mitigate cross-border tax disputes and as part of delivering on the overall deal to eliminate digital services taxes and other unilateral measures. We're not privy to the overall impact on the tax revenues for individual countries, from including the domestic autonomous business exclusion design feature. We anticipate that the overall aggregate tax revenues for most countries, including the US, would not change much. However, it is possible that it could have a significant impact on the tax revenue of certain countries with a limited number of in-scope groups with operations that otherwise would qualify for a domestic autonomous business exclusion. Moreover, while it's speculative, it seems reasonable that the need for an autonomous domestic business exception will become more critical when the scoping thresholds are lowered. Smaller countries, in particular, should be aware of this when looking at their projected tax revenues under Amount A. Further consideration for this design feature should produce a more robust, accurate, and sustainable set of rules, which may prove critical when countries move to ratify these measures. An autonomous domestic business exclusion will serve to limit the likelihood of extreme results from occurring in specific countries that will be hard to justify. Failure to address this may also create political challenges for getting any multi-MLI or local legislation implemented in some countries. In conclusion, a properly designed autonomous domestic business exception has the potential to ensure that the Amount A calculation will generate a more accurate and reliable allocation focused on a more targeted reallocation of profits of globally integrated businesses without unjustified outcomes, and thus deserves further consideration. I'll be happy to address any questions at the end of the panel.
I was waiting for Michael to come in, but of course I am moderating, so I will hand over.
Thank you very much. Thanks, Akam. Thank you for giving us the opportunity to be on this panel. As you mentioned, I'm here not only as the VP of Tax at Google, but also representing the Silicon Valley Tax Director Group. For those of you who don't know, Silicon Valley Tax Director Group is a US-based coalition of some of the most innovative companies in the US that invest very heavily in R&D and infrastructure. To start, I want to thank the OECD for all the work that has been done. Akam, as you've mentioned, there's a lot of progress on these rules, so I do want to take a second to thank you for that. In particular, I want to recognize the important change from the transaction-by-transaction approach to more practical, feasible approaches that still have as their objective a focus on users and end customers. Also, the addition of the predominant character rule will provide welcome simplifications, so very much appreciate that. Ultimately, the success of this project will depend on whether the rules can actually be implemented in practice. So it is important that we continue this constructive discussion about available sources of data, reasonable system changes, the right level of review, and appropriate allocation keys where they are needed. As a general guideline, we believe the rules, or at least the commentary, should emphasize that taxpayers are allowed to use reasonable business judgment based on the information normally available in the ordinary course of business to demonstrate that the chosen indicator for revenue sourcing is consistent with the stated sourcing rule for for a particular category. It should be clear that a reasonable application of that data, particularly if it comes from an effort to use the type of data enumerated in the rules, should meet the objectives where more granular transactional level data is not available in the ordinary course of operating the business. For example, in the case of revenue from digital advertising, a taxpayer's proposed sourcing approach should be regarded as reasonable if it is focused on the location of the ultimate user, which would be the advertiser in that case, is taken from data that is collected in the ordinary course of business, does not create potential privacy implications, and does not require significant costs and resources to implement when there is no other compelling business purpose to gather that information. As another example, throughout the progress report, an indicator may be used only if it is consistent with the stated revenue sourcing rule. This and similar mandates should always be considered conditioned by providing that the taxpayer can establish that the method is reasonably consistent with the stated rule. And again, we should qualify that what is reasonably consistent must take into account that the nature and quality of information available to taxpayers will differ across taxpayers. In the case of businesses with over 20 billion euro of revenue, the demands of operating at such scale will always mean that the revenue sourcing rules cannot be applied with precision to all parts of the business, such as small and emerging product lines, legacy businesses from acquisitions, and the like. More simplified allocation keys, simpler approaches, for example, using billing address, or broad flexibility to use any reasonable approach should be extended for any product areas that represent a lower percentage of company revenues than a set threshold, such as 5%. Given the move away from transaction-by-transaction approach, we would like to continue the dialogue with the OECD to understand what is meant by the general references in the report to the expectation of accounting for differences in products and prices in different jurisdictions. If this is indeed an objective, we will need to develop practical solutions and guidelines to accomplish this goal that do not rely on transaction-by-transaction data. We also believe that the rules that focus on third-party customer data are unlikely to be successful and practical. We appreciate that there have been some relaxation of requirements to obtain information from third-party customers to implement the sourcing rules, but those requirements still exist in certain places. Third parties are highly unlikely to disclose this information. As a general matter, the sourcing rules should be applied based solely on information available to the group and collected in its ordinary course of business. It is not commercially realistic to require suppliers to request sensitive business information from their customers. Groups should be able to rely on a variety of reasonable and publicly available sources and market data, including point-of-sale data and digital software download information. Now I'll turn to the section of the report covering the internal control framework. Since all Amount A taxpayers will have undergone rigorous financial audits by external auditors who are responsible for reviewing tax compliance by the group in all countries in which the group operates, we do not believe that any additional controls will be necessary beyond what is normally in place to manage a global business. We suggest that great deference be given to the information review processes and controls already in place. Additionally, the progress report states that this internal control framework must be endorsed by the group's board of directors, but we believe that this should be the responsibility of those persons with operational responsibility for financial affairs, as it normally would not be considered the type of issue to be addressed by the board of directors of a 20 billion euro group. We regard compliance for Amount A determinations to not be sufficiently different from all other tax compliance so as to warrant a special procedure. Turning to some specific sourcing rules that impact members of our group, for cloud services, which appears to be included in the other services category, some Silicon Valley Tax Director Group members have several million customers and tens and thousands of resellers and distributors. So it is important to understand the magnitude of transactions in forming a solution that is manageable. For sales of components, taxpayers should be able to rely solely on the information reasonably obtained in the ordinary course of business and complemented by publicly available information. Taxpayers may not have complete and accurate data in place of delivery to ultimate users. Pillar 1 introduces a novel approach that requires taxpayers to not only look to the location of their own customers, but to customers of their end customers or to consumers that are even further removed from the taxpayer. Information gaps are inevitable. For example, for sales of services through resellers, it is not practical to require sourcing by the location of customers of a reseller or to require for large customers that sourcing be based on place of use, since relevant location information will be unknown. I would like to end with a more general recommendation. We strongly recommend the use of more examples that tackle real practical data issues. We fully appreciate the challenge of writing rules that apply to all fact patterns, but some carefully crafted examples that show how practical solutions can be applied to some challenging facts would set the right tone, show that the rules can be applied in a feasible way, and give taxpayers confidence that vague or more general areas of the rules will not undermine certainty, and better ensure consistency in how the rules are eventually applied. Given all these very important benefits of the use of examples, we also recommend that they be incorporated directly into the rules so they are binding and will provide stability. Doing that could be a key step that alleviates much of the potential challenges that we have highlighted today. That concludes my prepared remarks. Thank you again for allowing us the opportunity to be on the panel. And I want to thank the OECD again for all the work they've done on this project. We know there's been many complex issues that have to be dealt with, but we appreciate it and working towards solutions that work for both business and governments. Thank you.
Thanks a lot, Tom. Now, we're all talking about different topics, so it's a little difficult to get a discussion amongst panel members that talk about different aspects. Maybe just 2 comments on what you've just said. I mean, we have looked at the comments and we're going to revise to the extent necessary, you know, as we did in the past on revenue sourcing. We've heard the comment that there's many aspects that would be in the commentary examples that you refer to where business makes a clear point that those need to be binding, so we need to reflect on how they can be made binding, and that's clear. And we're working on the commentary already in the TFDE where there's many of the discussions we had with several of you to make sure that, you know, we translate the rule the next level down so that the application will also be as the rule intends. Then just one point briefly, if I may, on the internal control framework and the discussion around it. And without getting into too much detail, the essential idea here is that when you move into this early tax certainty process, where you start from the proposition, which is not where we are right now, that individual countries would look at, you know, potentially auditing this, and to standardize this process, to have one process, so when you roll into this early tax certainty process, on that particular point, that you would think about having something in place that people have confidence in. So on an annual basis, people would then just look at the number that that system generates without necessarily questioning every time the system itself that generates that number. It is not to suggest that you need to go and not trust what you're doing already for financial accounting, etc. The point is just at the moment you probably don't have anything, as you say, in place that specifically allows to have a system that generates information by reference to the market jurisdiction. And it's sort of very specific to things that are specific to what is required in the Pillar 1 space, and the thinking in some sense as a simplification, can we agree on what it is that will give tax administration confidence so that then going forward we simply look at the number that that generates rather than question whether we have confidence in the generation of that number. Maybe that's just this commentary, a bit sort of genesis on this. With this, maybe I hand it over to Janine.
Thank you very much, Akim, and thank you also to the OECD for a further opportunity to keep us all honest, I hope, as we go through this process. It's in everyone's interest, taxpayers and tax administrations alike, to stabilise the international tax system, and that's the goal that we are all working towards. So, as Akim mentioned, I have the job of speaking on behalf of business at OECD, but also Unilever on the topic of tax base. And I will be gathering together a bit of a smorgasbord of different issues. So I'm going to talk about profit shortfalls and tax losses, where a group is less than 100% owned, a subsidiary in a group is less than 100% owned. What happens with assets acquired on acquisitions? And then finally, you'll be pleased to know I'm also going to mention withholding tax, but not to duplicate the comments that have been made already. So, on the subject of profit shortfalls, the corporate tax system, put very simply, uses zero as the dividing line between having a taxable profit or a tax loss. And if you are in a tax loss, most corporate tax systems give you the opportunity to use that tax loss. There may be limitations. Maybe there's a 50% haircut on it, as some jurisdictions have more recently introduced, but you will get to use that loss before you're paying tax. Within Pillar 1, we have 10% of sales as the dividing line to determine whether there are residual profits and whether you get an Amount A allocation. It seems to be logically consistent that where you dip below, otherwise you meet the requirements to be in scope, but you dip below the 10% in 1 year, but you're above it in subsequent years, that you would get the opportunity as a taxpayer to recoup those earlier losses before you are calculating Amount A. And there doesn't really seem to be any policy rationale for this decision. And it's particularly egregious, I think, where you have a group that is very near the 10% threshold, and cumulatively over a period of, say, 4 years, it can earn exactly the same in profits as another group, but one will be within Amount A and the other won't be within Amount A, and that's not a level playing field. The second area I would call out is in the area of tax losses, and I think there are two things here. First of all, there is quite a short period for pre-Pillar 1 losses to be taken into account. There's only a 3-year carry forward. And once you're in the Pillar 1 regime, the loss carry forward period gets extended to 10 years. However, in many countries, the loss carry forward period is longer than this. And so, again, the question would be, what is the policy rationale to create these restrictions, as they seem a bit arbitrary? And then finally, we did ask ourselves, when it comes to loss carry forwards under Pillar 1, this may well create deferred tax assets to be taken account of. What then is the interaction with Pillar 2 on these? So a further point to be reflected on. So if I could have the next slide. So my second topic concerns those entities that are consolidated but are less than 100% owned. And what the model rules say at the moment is that if you've got an entity that's consolidated on a line-by-line basis, then you include all of those revenues and profits for that entity. And I'd like to give you an example of, for Unilever, where we're a publicly listed group, but we also have a publicly listed subsidiary in India. It's approximately 60% owned. I've rounded the numbers to make it easy. And therefore 40% of the results of that publicly listed company in India actually belong to minorities. So if you just think about the scenario for Amount A, if India happened to be a relieving country for Amount A, it would be having to give tax refunds in respect of profits that are not actually economically owned by the M&E taxpayer. And if, on the other hand, it is a receiving country for Amount A, it will be receiving a share that's based on revenues that are not economically owned by the M&E. Because if you're consolidating 100%, you would be including in the revenues 100% of the revenues for India, realized by this publicly listed subsidiary. And so, in effect, that would lead in the formula approach to other countries subsidizing India for that. And if you follow this right the way through and think about, and I know the proposals on this haven't been released yet because they're still being developed, but if you follow this through to tackling the issue of what happens when you have a group which is entitled to relief under Amount A and would be receiving either a tax credit or a tax refund in a country like India in my example, what then happens because of the minority shareholders? because clearly that tax refund needs to go 100% to the M&E group. Why is that? Because they have paid 100% of the tax on the other side of the equation. And in the context of the financial statements of this publicly listed entity, we need to make sure that the distributable reserves are not disturbed, because that's the source of the dividends that are going to be paid out in the future, 40% to the minority, 60% to the M&E group. And in our particular scenario, we actually think that India will be a relieving country for Amount A, based on our modelling and based on our understanding of the rules as they exist at this time. So what's our proposal to remedy this? We think that it makes more sense from a policy perspective to treat consolidated but less than 100% owned subsidiaries in exactly the same way as jointly controlled entities are treated in the rules. And that would mean that you would use the M&E's proportional share of revenues, so 60% in my example. You would make an adjustment so that only 60% of the profits are brought into account. And I think you would also have to alter the group RODP calculation to take account of those changes. So next slide, please. So the final element of the tax base smorgasbord relates to assets and tax base adjustments. So the model rules require that where there is an acquisition, the historic accounting basis is used, and this requires a reversal of any acquisition accounting that may have been pushed down to entity level within the group financial accounting system. And then if there is a gain or a loss on an asset, it has to be spread over the year of the gain or loss and the following 4 periods. So that's designed to be a smoothing mechanism. The observation I have is that even in the context of my own company, we will regularly make acquisitions. We might make 2 to 3 reasonably large acquisitions every single year. Every single year that you make those acquisitions, the record keeping is going to grow ever more complex. And it's quite easy to foresee a time when, quite honestly, it becomes ultimately unmanageable. The second observation is that pre-Pillar 1 acquisitions and asset gains or losses are excluded. At that point, it's unclear whether that's the case or not. So we would ask or suggest that there's a review undertaken with respect to the requirement to use historic accounting asset basis for acquisitions, that there is clarity given on the treatment for pre-Pillar 1 acquisitions, and also if there is an option for taxpayers to actually do something different if it simplifies all systems automation or record keeping. So my final slide, because I had 2 slides on withholding taxes, but one has been covered already. So this is the other side of it. So this really is the interaction with elimination of double taxation. And we've got a fairly simple fact pattern here. We've got an IP company that charges a royalty of 100, there's a profit margin of 40, a tax rate of 25%, and there's withholding tax suffered in total of 10% on those royalties of 100. And as you can see in the simple calculation, the profit, the corporate tax on the profit of 40 is completely eliminated by the offset of the withholding tax credit on the royalty income. In this type of scenario, what happens is there's no actual cash tax paid in the jurisdiction of the IP owner. And unless the IP owner is in a large market that provides a dilution effect, the IP owner could be a relieving jurisdiction due to the high profit margin. So obviously facts may differ, but in my particular example, there's a smaller market and the royalty income is a higher proportion, therefore, of the jurisdiction level profit. Now, obviously, from the perspective of that small market country that is an investment hub and receiving royalty income, in my view, it should not be placed into the position where it's having to give tax refunds where it's actually not received any tax in the first place. And the proposed remedy for this is to deduct grossed up withholding tax from the elimination profits. And so in this particular example, what would happen if the elimination profit otherwise was 40, then you would gross up the effect of the withholding tax of 40, and actually the elimination profit would be reduced to 0 in this particular example. Obviously, all the examples are going to depend on facts and circumstances. So, back to you, Akim.
Thank you. And keeping with tradition, just a couple of small observations before we then, I think, move on to unilateral measures. And as you say, it's a bit of a mixed bag of various aspects that are important as we think about the tax base. And there's others, you know, the alignment of the tax base amongst the allocation tax base, the elimination tax base, and the P2 tax base. And, you know, there's a whole host of tax base questions. But thanks for pointing those key issues out. I think on the profit shortfalls, and also looking into the first row here, I think it's also clear that there's some other people that feel equally strongly that this concept does not make sense. I'm not suggesting, you know, that I'm taking sides necessarily, but I think we also do need to see this in the context of the averaging mechanism, which we do have. And so I think it is a wider constellation of issues. You know, if you also point out that, I guess, as was pointed out this morning, that, you know, there's wider stakeholders, and the overall package needs to make sense also for those wider stakeholders. And a large number of those wider stakeholders do not believe strongly in the concept of profit shortfalls, including the implications that would have on the residual profit overall. So just pointing that out and pointing to the fact that, you know, part of that debate is also taking place in the averaging discussion, which, again, commentators raised about the changes from the earlier public consultation document to the version that you have seen. I think on the question of minority interest that you raise, I think there's specifically sort of a footnote that says, you know, provide us input, so we're grateful for the input. I think that's an ongoing discussion with different delegates on different sides, which is why it's in some sense signposted in the consultation document that we read input into. Thanks a lot for the input. On the withholding taxes, again, we've heard that. We can see the implication on withholding taxes that really come up in two places, right? They come up in the elimination debate, and they come up in the MDSH. They come up as a question of elimination. They come up as a question of double counting. If we move into that space, I think we need to solve both of these elements, and we're reflecting on it, and we're grateful for the input. I have the great privilege, of course, that you can't respond to me because I'm the moderator. But if you wish, then you absolutely can, of course. We do have a little time. But otherwise, we would move on to unilateral measures, where I think we have Megan first.
Great. Thank you so much. And thank you for the invitation to contribute to today's discussion. And thank you to the Secretariat, the Inclusive Framework delegations, and stakeholders for their dedication to making this project a reality. Megan Funkhouse, Trade Policy at ITI Technology Industry Council. ITI represents the breadth of the global technology industry: hardware, software, cybersecurity, services, cloud providers, platforms, consumer technology products, and technology-abled companies, all of whom are on the cutting edge of innovation. We have our global headquarters in Washington, D.C., an office in Brussels, and representatives on the ground in Sao Paulo, Seoul, and New Delhi. Our member companies, some of which you've already heard from today, commend the Inclusive Framework and the OECD for their continued technical work to build out details of the two-pillar approach. As mentioned, I'm using my remarks to emphasize and elaborate on ITI's comments on relevant similar measures. Inclusive Framework members have collectively decided to establish new taxing rights through Amount A. The other element of that compromise is Inclusive Framework members collectively deciding to provide for the withdrawal and future prohibition of digital services taxes and relevant similar measures for all companies. As noted in the progress report, the Multilateral Convention will contain provisions requiring the withdrawal of all DSTs and relevant unilateral measures with respect to all companies, as well as a commitment not to enter into such future measures in the future. The success of the project, both in terms of achieving certainty and stability, as well as its durability, is directly and significantly impacted by the strength and effectiveness of the definition of relevant similar measures. The conditions outlined in the progress report, however, appear to leave room for many harmful unilateral measures to remain in place, which would mean that taxpayers confront a reality of some sort of Amount A adoption layered on targeted gross-based taxes, withholding taxes, and other novel approaches. If there is a narrow definition of relevant similar measures, there is significant risk that we could see a proliferation of unilateral measures that contravene longstanding international tax principles, promote de jure or de facto protectionism, and or attempt to ring-fence aspects of the digitalizing economy, because these measures may be implicitly deemed permissible if the measures do not neatly fit into a narrow definition of prohibited measures. Again, if a measure is not explicitly prohibited as a relevant similar measure, which is the risk of a narrow definition, is that measure then implicitly permitted? This matters because a major incentive for governments and taxpayers alike in supporting the development of Pillar 1 was the elimination of DSTs and relevant similar measures. If that promise is not kept, it is likely that support for Pillar 1 could wane. The evolution of scope from the first DST proposal to those being considered or adopted in more recent years demonstrates the importance of developing a forward-looking and comprehensive definition. Consider the first generation of DSTs, targeted unilateral tax measures that share characteristics such as a tax on gross revenues instead of net profits, multiple thresholds that target globally successful companies, and a narrow scope for which digital activities are covered that largely excludes domestic competitors from liability. A second generation of unilateral tax measures go far beyond the initial scopes to capture all transactions involving non-resident companies for which one or more aspect of the transaction takes place online. We are now witnessing a new generation of unilateral, uncoordinated, and problematic measures. Even since the Inclusive Framework's October 2021 statement, which notably commits jurisdictions to a moratorium on the imposition of new measures until the end of 2023 or the implementation of a multilateral convention, several jurisdictions are publicly considering or advancing novel categories of taxes that challenge longstanding international tax principles and will undoubtedly lead to double or multiple taxation. For example, in 2022 alone, we've seen approaches such as establishing significant economic presence as a nexus for corporate income tax, considering an online sales tax applied to some businesses as a means of reducing business rates for other businesses, issuing well-established international norms for the tax characterization of certain transactions, and attempting to unilaterally override commitments made in existing bilateral tax treaties. Not only are these developments concerning with regard to ongoing efforts to finalize and implement the multilateral convention for Pillar 1, but they provide a preview of different unilateral taxes that we could expect to see in the absence of a robust and comprehensive definition of relevant similar measures. And what are the consequences of a narrow definition of relevant similar measures? We enter a paradigm, a gray area, if you will, of tax measures that lay between a small set of unilateral tax measures that are clearly prohibited, and then the many categories of taxes that adhere to longstanding international tax principles. And a proliferation of measures in that gray area would reignite the uncertainty and instability the Inclusive Framework is actively working to alleviate. When the Inclusive Framework crafts the definition for relevant similar measures, those discussions must be forward-looking and attempt to account for the ways in which governments may adapt tax measures that do not conform with the spirit of this project and multilateral cooperation. So now that I've underscored the importance of a robust definition of relevant similar measures, I will share some observations on the guidelines as described in the progress report. To refresh everyone's memory, the Multilateral Convention will also include a commitment not to enact DSTs or relevant similar measures, provided they impose taxation on market-based criteria, are ring-fenced to foreign and foreign-owned businesses, and are placed outside the income tax system, and therefore outside the scope of tax treaty obligations. The use of "and" in that list, as opposed to "or," raises serious concerns that the Multilateral Convention will not adequately protect against the adoption of new measures that would undermine the stability and certainty sought by the two-pillar solution. It should also be made clear that these protections apply whether the criteria are met on a de jure or a de facto basis. In looking at which companies will be liable for a tax, are most or all of the affected companies headquartered somewhere else? Even if the tax does not specify only foreign headquartered companies, a tax that in practice only applies to, or mostly applies to, foreign headquartered companies should be considered a relevant unilateral measure and therefore prohibited under Pillar 1. We would also encourage the Inclusive Framework to consider prohibiting measures that attempt to ring-fence specific industries. Now, looking to the exclusions, The commitment would not include value-added taxes, transaction taxes, withholding taxes treated as covered taxes under tax treaties, or rules addressing abuse of the existing tax standards. That final clause, rules addressing abuse of the existing tax standards, raises the potential for a measure that meets one or more criteria for prohibited measures, but is characterized by the introducing jurisdiction as intending to address abuse of existing tax standards. Further clarity would be needed on this point, as it introduces more subjectivity into the characterization of a measure, and it could also lead to a tension between what a jurisdiction says a measure will do, as opposed to the effect of that measure. We also recommend clarifying that the exclusion only applies to value-added taxes that are designed in accordance with the OECD 2017 International VAT GST guidelines. Value-added taxes that do not adhere to these guidelines should be open to evaluation as relevant similar measures. It should also be made clear that the criteria for relevant similar measures applies to subnational taxes, not only to those at the national level. Otherwise, subnational jurisdictions could simply enact DSTs and relevant measures and completely eliminate the stability the international community has worked so hard to attain, and which is one of the fundamental goals of the two-pillar solution. As a final note, we are encouraged to see consideration in that progress report of what happens in the event a jurisdiction adopts a measure that violates the criteria identified in the Multilateral Convention in the elimination of Amount A allocations. I want to close by emphasizing again that the durability of this project depends on the strength of the definition of relevant similar measures. A narrow definition, again, may open a paradigm whereby a problematic measure, that is, a tax measure that clearly disregards international tax norms and principles, may be implicitly allowed if it is not explicitly prohibited. Such an approach would restart the tax disputes and trade barriers that today's project is intended to resolve. This statement I'm about to share comes from the April 2021 OECD Secretary General tax report to G20 finance ministers, but bears repeating here because it plainly states the broader trade and economic risks associated with pursuing unilateral approaches. In the current context, international tax cooperation is even more important to ensure that tax disputes do not turn into trade wars, which would further harm recovery at a time when the global economy can least afford it. To ensure the effectiveness of Pillar 1, the inclusive framework must collectively and comprehensively identify the types of measures that stand to undermine Pillar 1. Last but not least, we greatly appreciate the opportunity here to elaborate on our comments in the context of the progress report. However, I cannot stress enough the importance of providing a formal opportunity for stakeholders to provide feedback on provisions to identify relevant similar measures. Thank you again for organizing today's public consultation event. On behalf of ITI, I look forward to continuing to engage with you, and I'm ready to answer any questions you may have. Thank you.
Thank you, Megan, and hopefully next time we see you in Paris. I hand over to somebody who we do have in Paris, and that's Anne Gordon. The floor is yours.
Thank you. And thank you to the OECD for inviting me to participate today on behalf of NFTC and to my co-panelists for their thoughtful remarks. I am aware that I'm standing between everyone and a nice glass of Bordeaux, so I will try to be succinct. NFTC is the premier business association for advancing trade and tax policies that support access to the global market. Founded in 1914, NFTC promotes an open, rules-based global economy on behalf of a diverse group of members. We have currently nearly 100 members, and our membership spans the breadth of the national economy. It includes sectors such as energy products, capital goods, transportation, consumer goods, technology, healthcare products, services, e-commerce, and retailing. We wanted to, again, thank the OECD for being able to elaborate on our comments. We welcomed the reiteration of the commitment in the overview to the consultation document to withdraw all existing DSTs and relevant similar measures for all companies, including a definitive list of the existing measures to which this applies would aid in providing certainty, and we appreciate the inclusion of this in the consultation document. The beginning of work on a standard for such measures in the overview is also welcome. However, we know that the work on unilateral measures is far from complete. The objective of Pillar 1 is to replace problematic and overlapping tax systems with a coherent new system on which IF members can genuinely reach consensus. Unless unilateral measures are removed from the policy agenda, this multilateral exercise may simply create a novel taxing rate along with a myriad of unilateral measures, not fixing the problem. In determining which provisions are relevant similar measures, we would like to stress that this should include any tax measures that are discriminatory by industry, act as trade barriers, or are targeted predominantly for multinational enterprises. While the overview notes that a measure must discriminate against a foreign business, reliance on whether the statute only applies to foreign entities could be misleading. For instance, a standard could be set such that the threshold only applies to foreign businesses. And so therefore we stress that any standard for relevant similar measures must apply both to the letter and the spirit of Pillar 1. While we understand that withholding taxes treated as covered taxes under tax treaties will not be considered measures that must be withdrawn of Amount A, it is imperative that they are included in the Amount A calculation. As people have said earlier today, we urge participating jurisdictions to come to a principled agreement that withholding taxes imposed on deductible payments made by a member of a covered group presenting the tax jurisdiction's assertion of tax rates on the profits of that group must be taken into account in the MDSH and more generally the calculation of Amount A. The failure to do this would permit a backdoor around the rules and objectives of Pillar 1 by allowing market jurisdictions to tax residual profits greater than permitted under Amount A. The failure to address this issue in a principled manner will result in a proliferation of withholding taxes, destabilizing the system and undermining the objectives of Pillar 1. Direct taxes imposed on covered groups such as gross basis withholding should either be accounted for in the calculation of Amount A or withdrawn as part of the commitment to withdraw DSTs and relevant similar measures. We also request additional clarity on diverted profits taxes, which are noted only in the context of determining the elimination tax base in Schedule 1. Compliance by multinationals will also come into play, and therefore the rules and resulting calculations must be easy to discern and readily determinable. As currently envisioned, calculating Amount A, taking into account the MDSH and elimination, is very complex in practice. Therefore, we implore the OECD to take any and all efforts to mitigate the complexity entrenched in the current framework for Amount A and implement straightforward rules. We also know that Pillar 1 is an agreement that countries are entering and will limit certain states' sovereignty by preventing the imposition of new taxes, and we know this is a challenge. However, this is a compromise that allows a new taxing nexus, and the OECD must ensure that the consequences outweigh the benefits of imposing a DST or other tax. Thus, there needs to be a mechanism that allows a company or their government to raise concerns about a unilateral measure along with an arbiter of the complaints. Furthermore, there needs to be repercussions beyond a simple reduction in Amount A for the countries that fail to withdraw or impose new unilateral measures. Limiting the consequences only to a reduction in Amount A may not provide enough disincentive if a new DST or other measure would provide more revenue than an Amount A would provide. Separately, as Megan spoke to a little, we know subnational taxes are unlikely to be included. From the US perspective, subnational taxes are not controlled by the federal government. Federalism prevents the entanglement of the federal government in matters retained by the states. So when a state such as California or New York imposes a new tax, that is completely separate and apart from US Congress and the Department of the Treasury. But in other countries, there are different systems. And to the extent that a federal government has control or influence in subnational taxes, we would strongly urge that unilateral measures are not imposed to that level to circumvent Pillar 1. However, we understand it may be impractical to govern all subnational actors. We look forward to reviewing additional details on what compromises a unilateral measure and the governance mechanism that the OECD plans to employ to ensure all current DSTs are removed and no future measures are implemented. So again, thank you for allowing me to participate today, and we look forward to future engagement.
Thank you very much, and just like Pillar 1, this panel is slightly ahead of schedule. Now, we have 2 questions. I think we'll take those 2 questions. I'll give that second question to the panel. The first question is a question to me, so I'll give you the second question if somebody wants to respond to that. That relates to revenue sourcing. Could be Tom, but it doesn't have to be Tom. All of you will have to do revenue sourcing of some sort. A number of commentators requested and when verifying the internal control framework for revenue sourcing, existing enterprise resource planning systems and audit processes should be respected as far as possible rather than acquiring new system and processes solely for the purposes of Amount A. Can you explain how you see that working in terms of timing and why tax administration should take comfort in it? If you have any reaction to this, if you don't, you don't. The second question, I think, is a question that I probably have to take. In a number of the submission into the consultation process, this, I think, is on the regulated financial services exclusion, raised concerns that financial services exemption could create unlevel playing field and potentially distort competition if the line drawing isn't done correctly with some out and some in, and whether, you know, we would be review this in the future. Maybe then on that second point first, I mean, first is, this is a consultation document, so if the line drawing isn't clear, we shouldn't expect that the line drawing is the line drawing, so happy engage with the technical teams to see where that particular line is and whether that is the line that is intended. There is a line that is intended, and we can debate, you know, there will be voices that be saying there shouldn't be a carve-out at all, but that's where we are, and certainly that line drawing is a line drawing that will raise some challenges, as a line drawing does. But the first question is, you know, engage with the delegates, engage with the Secretariat, to see whether that is the intended line. Then I guess some are also suggesting that not necessarily is it bad to be included. If we deliver on the tax certainty and the other things, maybe you would want to be included. We had under earlier scopes some companies that would have liked to be included. It's certainly the minority, but one shouldn't sort of assume that, you know, being out is good and being in is bad. That's certainly not the long-term desire of this. And will we monitor broadly how this works? Absolutely, and I think you already see this, that, you know, when we drop it down, I think there is like, we see whether the system actually delivers what it does. So I gave a relatively long response to give you guys some time to think about whether you wish to say anything on that other question on revenue sourcing. Are there any views on the audience that want to respond to that question?
Well, I suppose in our particular fact pattern, and obviously, you know, everyone's in a different place, but we have a largely decentralized business model, which means that the majority of our sales within a jurisdiction are actually recorded by an entity in the jurisdiction. So our existing audit and financial processes should be quite well could be quite supportive of providing the confidence required around revenue sourcing. There are two scenarios where more work would be needed. The first is, it's quite common if you're not present in an adjacent market for the sales to be made from the market next door. So capturing those and distinguishing country A sales from country B sales is important. And then the second one is the use of global distributors, where the distributor footprint may not be restricted to a single market or a single region. And there, you know, we've engaged actually with the OECD Secretariat on this point. It's something that would be a common scenario, I think, for many businesses. So what do you do then with your global distributor?
And I won't answer for Silicon Valley Tax Credit Group, but I'll answer for Google. So the sourcing that obviously is proposed as part of this is not normal sourcing for us. We source based on where the billing address. So this is a new sourcing process. So it'd be something that we would have to come up with the systems in order to do that, and we'd want that as part of the advanced certainty process, getting approval for that. But like I said, you know, our auditors would also be looking at that as part of the new process. So we would do that in conjunction with that process.
Thanks a lot. I think we have concluded on this panel. As somebody indicated, there's a glass of Bordeaux, wherever that is. Tell me where that is, I'll also go there. I think I will then also conclude with the closing remarks. That is me this time around, and I won't keep you for a half an hour with long closing remarks. Maybe just a couple of words. I mean, first, I think for us, the written submissions and also today was extremely rich. I think we probably feel validated that we focused on MDSH, withholding taxes and elimination for, you know, the separate panels. Clearly the message, I think, on MDSH that we take away is from all the different voices, we're probably not quite there yet. I think also as you reflect on this, we take away what Gael also earlier said, that some of the parameters within which we operate in the MDSH, being a jurisdictional approach and being a quantitative approach, are relatively stable, but there's questions inside of that where we take all this away. We recognize, I think, what you said and what we also earlier said, that we need to get the right balance between having a system that is simple and achieves the policy objective, but doesn't throw up too many results that would be very difficult to justify, and finding that particular line is a challenging exercise. We do need to accept that there will be examples that may not be intuitive of any variation of the system, but minimizing those instances and doing this intelligently is certainly something that we take away. When we go to elimination, I think we don't want to repeat the whole panel. We've had that. It's just funny, of course, when you think about it, that nobody in this room, when somebody mentions the X factor, thinks of anything other than taxation. But I think that's probably sort of telling about the audience. We talk about the X factor. And of course, there's the Y factor, and it's all part of an elimination in Pillar 1, so that is somewhat comical. But you know, we're being on the lighter side and talking about Bordeaux glasses coming soon. And I think I'm not going to repeat this panel or so, but you've heard some of the things that we are clearly focused on, and thank you for those contributions. And the idea of really improving this, I mean, if you take revenue sourcing as an example, but just an example, I mean, it's been a journey. It's a journey where we intermediate also to the delegates that decide about their expectations, and it started out with an extreme transaction focus, with people worrying about if you're using Google on the Eurostar and does France get the money or not, and I think we've come a long ways, even if you don't see it. But there's still a journey to go, and I think that the rest is the same is true for some of the other building blocks that maybe haven't gotten yet the scrutiny because they came out later. I think the important point, and I'm coming back to the forest just ever so briefly to remember the forest, where we also look at the tree, right? No tree without forest. So we do need to have a both. But the big picture of the solution, if we just bear this in mind, I think, you know, it's a solution where we don't pick on a small group of foreigners, right? And so that needs to be the essence. It's an approach where we tax net and we don't tax gross, and then you all say, but that's really difficult, and that's why we have this discussion, but the alternative is gross. That's much easier. We recognize that. And an approach that you say that avoids double taxation as part of that. And that has a whole host of complexity. I think integral to this, and others have said this as well, is the tax certainty dimension. It's not an add-on, it's not a concession to a country, it's not a concession to business. We are building on the existing system that can only work if we stabilize that system, otherwise we can't put the amount A on top. So I think it's just part of this approach and not a concession to anybody. I think, and then we've heard at the end the removal of DSTs, the unilateral measures, and quite frankly, of course, you know, in that broader category is also some of the audit experiences that you have that de facto get close to some DST that isn't in law but in practice. And I think that's important. But then as we do this also and I'm coming back to also the first panel, you also need to recognize that if this is meant to stabilize the global system has a lot of actors and they need to agree to this. And so this needs to be beneficial. This needs to be something that people around the world buy where you do business, and that requires us to be open and have in mind. And that's why we bring these diverse voices on withholding taxes, on other aspects here. So you see the totality of the views that we are dealing with. Maybe just on one point, you raised this earlier, and there was also some questions for which we didn't have time. And speaking about, for instance, also developing countries, and that's a point that we're coming in. The Pillar 1, we do see, as you would expect, that, you know, it does raise revenue. It's not a revenue raiser intended. It's a reallocation to stabilize the system. But of course, you know, when we do the impact assessment, and we do see that, generally speaking, if you take profits that are not insignificantly in investment hub and put them in market jurisdiction, that does raise revenue. So we do see an increase in the overall revenue. But of course, Frank, I guess, as you were saying, that's a bit specific. If you're a very decentralized business and all your residual profits are already in the market, well, then it doesn't do anything. But if you look by and large with everybody in scope, that is not true for the whole range of groups. And then last, also not to forget that we're also here in a wider world where, you know, one of the objectives of this also is to take some tensions out of the system that are not on the tax side, but on trade tensions and other things. And so this is a contribution to stabilizing not just the international tax system, but, you know, the wider tax system, which I think is particularly important at the current time. And then I guess to finish in my remaining 2 minutes, just on a lighter, on a positive note, to prove the fact that we're actually listening to business and we take these comments very seriously, we've hired one of the principal drafters who sits quietly in the back and will now be working for us. So Kaidi, thanks very much. She's now joining the Secretariat, so didn't want to forget that. You will have also seen that we quietly had the incoming director come in and listen and go out, and we have the current director come in and go out. So, you know, that all of these people are listening, and Itai Greenberg is also listening, gives us all cause for optimism. Thank you very much.